Yes, good evening everyone. Please check, am I audible and is the screen visible? Yes, please confirm. Yes, Karthik, good evening. Just one moment and then we'll start. Yes. Perfect from my end. Yes. Okay then, let's start. So today we'll be covering entire IND AS 115, that is revenue from contracts with customers. Uh, in this IND AS, I'll try to recall each and every concept. Each and every concept I have given an example for every concept, and I've also taken the exam questions. So now I'll be starting with this IND AS. See, this IND AS is a bit lengthy, not very tough, but yes, I will say it is a bit lengthy, right? So please be patient and try to analyze each and every point. If you are able to analyze that point, if you are able to recall that point, it's okay. If you are not able to recall it, that is, if you are not able, if you are thinking that we need a revision of that, so just mark that point and you need to revise only that point. Okay, so let's start with IND AS 115, that is revenue from contracts with customers. Okay, so now what exactly do you mean by revenue? Revenue means nothing but sales. So this IND AS talks only about when to recognize, how much to recognize, right? When to recognize the sales and how much to recognize the sales. That is, at what point of time will you recognize the sales? So to better explain, I'll give you this example. So what is this concept? Let's say we are the Airtel company, right? And there is a customer, Mr. A, and Airtel is providing 1 year internet service, a router free, and installation free, and they are charging 15,000 from Mr. A. That is, Airtel is charging 15,000 from Mr. A, and we have to provide internet service for 1 year, router for free, and installation again free. See, over here nothing is charged for free. That is, we will not give anything for free. Obviously this 15,000 has something of the internet service, something of the router, and something of the installation also. So what we have to do is we just need to divide this 15,000 in all the three, in all the 3 points, right? So how will we divide this? How will you allocate this 15,000 in all the three? So the best example is over SSP. Now, what is SSP? Standalone selling price. Standalone selling price. That means if I will only provide you internet service, not the router, not the installation, what would have been the charges? If you purchase only the router, what will be the charges? And if you only install it, what will be the charges for only installation? So those are known as SSP, that is standalone selling price. Let's say the standalone selling price are given 1 year, it is 12,000. Only router, if you take, I will charge you 5,000, and only installation it will cost you 3,000. That means total of 20,000. Since you are taking the combo, that is 15,000 for 1 year package, so that means this 15,000 will be charged in the ratio of, it will be allocated in the ratio of SSP, that is 12 is to 5 is to 3. So for internet service, we'll provide 9,000, that is in the ratio of 12:3. For router, it is 3750, and for installation, it is 2250. Now, how will I recognize the income? See, I have already allocated it to three performance obligations, that is internet service, router, and installation. So how will I book? Obviously, to be booked over the period. Why? Because internet service I'm not providing right now. I'll provide it over 1 year, right? So I'll be providing it every month, right? Okay. Next, router. Is it a one-time service? The answer is yes. I'll provide you router, and that is it. So obviously, that income I'll book it on the spot. And next, installation. Can I say it is again a one-time service? The answer is yes. Again, 2250 will be booked immediately. So book immediately at one point of time, right? But tell me one thing. Are you charging 15,000 from the customer right now? The answer is yes. So the entry will be something like this: bank to sales, right? Bank to sales. But is the entire amount sales? The answer is no. the sales amount will be only of these two, that is 3750 and 2250. Why? Because these two are completed. Is the 1 year service completed right now for internet providing? No, you have to provide it over the year, right? So since that is not completed, you cannot say that you have sold the goods or completed the performance obligation. So at that point of time, you have to defer it. That means you have to treat it as an advance income. Advance income. So this is the entry to be passed. So I have written over here. You can check. So the entry will be bank to sales, that is revenue. 15,000 I got, true, but over the period I have to book only 6,000 right now. Why 6,000? Because it was 3750 and 2250, 6,000, and the rest amount will be treated as the advance income. Now after 1 month, can I say after 1 month you have already provided 1 year service? So 9,000 was for 12 months, right? 9,000 was for 12 months. So for 1 month, how much? So it comes to 750. 750 you will book every month, right? So what will you do? It will be advance income to revenue each and every month. That is 9,000. Out of that 9,000, 750 will be treated as revenue for first month, again 750 for second month, again 750 for third month, and so on. This is how you will recognize the revenue. Now overall, I'll be giving you this example again and again. So this is the crux of this IND AS, that is how to book the revenue. Whenever I make it a combo, so it will be a performance obligation, right? So this is the basic concept question. Now we'll start with this IND AS. So basically there are five steps to recognize revenue under IND AS 115, and that is CPTAR. Now the entire IND AS covers only these 5 points, and these 5 points will be again discussed in detail. So what I have done is I have discussed first point, and then I have again given the summary. Again the second point, again the summary. Third point, again the summary along with the questions. So that it will be a cumulative approach. You will get on the points and points and points. Okay. So the first point is identify the contract. Identify the contract. That means you have to first identify the contract, whatever the contract is between the two parties, right? Next, what are the performance obligations? For example, in this scenario, the example which I gave you, what were the performance obligations? What you have to perform? Can I say the performance was internet service, the performance was router, and the performance was installation? All these three things were the performance obligation from my end. That is from the point of view of Airtel, right? Next is determine the transaction price. What was the transaction price? It was 15,000, but each and every time the market price itself is not the transaction price. Why? I'll give you the example later on, right? So the third point is you have to determine the transaction price. So first of all, whatever the contract was, whether it may be written or oral, anything, right? Implied also. Next is what are the performance obligation you have to fulfill. Third is what is the transaction price, right? And the fourth is how will we allocate this transaction price? Obviously in the ratio of SSP. In the ratio of SSP, how will you allocate? And the last is how will you recognize? For example, I told you to book the revenue 6,000 right now and book the 9,000 over the period. So how will you recognize the revenue? As and when you satisfy the performance obligation. As soon as you satisfy all the performance obligation, you can book the entire revenue. If there are multiple POs, that is multiple performance obligation, as in this scenario, there was router, installation, and internet service. So router and installation will be treated as the two different performance obligation which I have completed, and the internet service will be completed over the period, right? So these are the basic 5-step model, which is nothing but CPTAR. What is C? Contract. P? Performance obligation. T? Transaction price. A? Allocate. And last is R, which is recognize the revenue. So these are the 5 basic points which you should consider while recognizing the revenue in your books. Okay, as per IND AS 115. So these are the basic 5 points. Now we'll discuss in detail each and every point. Now the first point states that what is basically a contract and what are the different terms associated with the contract. So let's discuss in detail. First of all, identify the contract with the customer. Now what is identify the contract with the customer? There should be a contract between entity and the customer. Contract can be oral or written or implied, but it should be enforceable by law. Okay. And next, an accounting contract exists only when an arrangement with a customer meets all of the 5, that is ARCTC. Now what is ARCTC? When will it said to be there is a contract? When will it said to be? So basically there are 5 points. If all the 5 are completed, only then at that time you can move on to the second point, that is the performance obligation. First of all, you have to check this ARCTC. Now what is this ARCTC? First of all, the parties must have approved, that is both the parties must approve that whatever the obligations are from both the ends, right? Second, the entity can identify each party's rights regarding the goods and services. Each party should know what are their rights, that is after complete the performance obligation, what will be the right. Okay. Third is there should be a commercial substance. Commercial substance means what? There should be something in exchange, right? Intra-group transactions will not be considered as a contract. That means within the group, if you are paying, if you are purchasing, selling, that will not be considered as commercial substance. Next, the entity can identify the payment terms for the goods and services to be transferred. That means the terms and conditions should be very clear. That is how much to pay, when to pay, and how in what sense you will pay. Will you transfer it account or will you be paying by a check or something, right? And next is it is probable that the entity will collect substantially all the amounts. That is, it should not be doubtful. That if even if you are doubtful, you should not consider the revenue, right? That means on day one, when you enter into a contract, when will it set to be into a contract? When all the 5 conditions are fulfilled. What are the 5 conditions? A, R, C, T, C. What is A? Approval. That is both the parties should approve. The second is R. R is rights. That is every party should know what are the rights and what are the obligations, right? The next is C. C is nothing but commercial substance. That there should be a commercial substance. Intra-group transactions won't be transferred, won't be treated, right? T. T is nothing but the terms. That is the payment terms. How much to pay, when to pay, and so on. And the last is again C, which is nothing but you should be the amount should be collected. If you are doubtful that you will not be able to collect the amount, you cannot book revenue at this point of time, and therefore it will not be told as contract, right? So these are the basic 5 points. So to sum up, what we have studied till now, we have studied the CPTAR, right? C is nothing but the contract. From the contract point of view, I've given you 5 conditions. What are the 5 conditions? A, R, C, T, C. A, R, C, T, C. Okay. Moving ahead. Now, what is the general rule? Do not recognize revenue until the conditions are fulfilled. Treat such consideration as liability, that is advance income. For example, if all the 5 conditions are not fulfilled, I'll treat it as the advance income, that is bank to advance income. Any advance income is a liability, right? So I'll be booking as a liability, not the income. Even if I'm getting some amount, I'll book as a liability because my performance obligation has not been completed yet. Okay, moving ahead. Exceptions. What are the exceptions to the first point? Revenue recognition, we can recognize even if we are not fulfilling all the conditions. For example, if substantial goods and services are transferred and substantial amount is considered transferred. Now, substantial is not defined. What is substantial? It is not defined. Let's say if you have completed 80% and if you have received 80% also, then you can book revenue. Okay, these are this is the first case, but this is not very important. The important is second point. I'll explain you with this example. So 5 conditions of step 1 are not meant, still we can book revenue. How come? See, there is Mr. A and there is X Limited. So Mr. A paid a token to order goods. So he paid a token. So we considered this as bank to advance income. Why? Because we haven't completed the obligation, right? We haven't transferred the goods yet. So it is just an order. He just gave an advance. Okay. Let's say 1 lakh was the advance. 1 lakh and 1 lakh. So I treat it as advance income. But after a few days, Mr. A cancelled the order and we forfeited the amount. Mr. A cancelled the order. He told that I don't want to order goods. So I told him that obviously I've already placed an order for you. I'll not return you this 1 lakh rupees. So I'll forfeit this. Can I say now this is my income? The answer is yes. Can I book revenue? The answer is yes. Because the 5 conditions are not met, still I'm booking revenue. So what will the entry? Advance income, which was my liability initially, but now this is my income to revenue. Revenue booked even if 5 conditions are not met. This is an exception. So even if the 5 conditions are not met, we can still book revenue. This was one of the exception to it, right? Okay. Now, what should be the contract term? See, if the life is, for example, internet service, right? Internet service was for 12 months. Let's say you have taken a package for 3 years or a 3 years contract, any contract, right? For 3 years, right? So, if at all any party has a right to cancel it within 1 year, or else after completing 1 year without penalty. If you can cancel, it can be cancelled by either party without paying penalty. At that point of time, I'll consider the term as 1 year only, because second year it is not your obligation. Can you cancel the contract? The answer is yes. Even I can cancel contract, and therefore we can say the life is only 1 year, not 3 years. Although we entered into an agreement for 3 years, but since either party has the right to cancel the contract after 1 year without paying any penalty, at that point of time the term will be considered as 1 year and not the 3 years, right? But what if the contract period is 3 years, and if any party cancels, they have to pay a penalty of 50 lakh rupees. 50 lakh rupees, right? You can cancel it at any point of time after 1 year, but at that point of time, if it is cancelled by any of the party, they have to pay 50 lakh rupees to the other party. That means now we will not consider it as 1 year, we'll consider the term as 3 years itself, because obviously 50 lakh is a huge amount and no one will try to cancel that amount, because If you cancel, you have to pay a heavy penalty of 50 lakh rupees. So in that period of time, in that point of time, you have to consider it 3 years and not 1 year, right? Okay, moving ahead. This was the contract term. Now, contract combination. Can you contract small contracts with the same party as a single contract? The answer is yes. You can combine the contracts. How come? See, 2 or more contracts with same customer and near the same time, maybe 15 days, 20 days, or even 1 month, right? Shall be combined to make a single contract if any of the following conditions are satisfied. The contracts are negotiated as a single package. For example, you came to me and you told me that, sir, I want SCM lectures first, and we'll also be purchasing the FR batches, that is CFR batches from you only, but we want this after 2 months. After 2 months. So you negotiated with the price, that is, you took a combo price for me for SCM and CFR. Now, can I say these were negotiated as a single package? Obviously, you gave me a confirmation that you will also purchase CFR, and I must have also taken a token amount from you, right? That means it was obviously it was negotiated as a single package. So can I consider this as a single package, that is a single contract itself? The answer is yes. You can consider this as a single contract. Okay. The amount of consideration paid in one contract depends upon the price or performance in the other contract. Obviously, I charged for SCM and gave some discount on CFR. Why? Because you already took SCM for me. Already took SCM from me, right? Next, the goods or services promised in all the contracts are of a single performance obligation, is part of single commercial objective. For example, see, if there is any one obligation to be completed, that is, I have given you the SCM and FR lectures straight at one point of time. That is, I gave you the activation key and all the lectures are yours right now. If it is like this, obviously I can combine that. Obviously, it will be only one single performance obligation, right? So in that point of time, I can combine. Till here, it was not very important. See, of the 3 points, of the 5 points, point number 3, point number 4, and point number 5 are very important. First two are only theory points. One point is there there with practical point in that is the first point. I'll explain you next. And the practical point starts from here. Contract modification, one of the very important point. What is contract modification? So to better make it very clear, I have given 3 examples on it, right? Please pay attention to it. What is the contract modification? The first point. So basically, I have given a contract for factory painting. Mr. A is a customer and X Limited is a service provider. So basically, we are X Limited and we are following IND AS 115. We are X Limited and we are the service providers. So Mr. A gave us a contract and that he told me that they have to paint a factory building. So I told them it will take 40 days and I'll be charging 1,000 per day. That means a total of 40,000, right? After 25 days, Mr. A gave one more contract for painting the office building. Now, office building is a new service, right? Initially, it was factory building. Now he's telling me that you also paint my office also, right? So at that point of time, I told him 20 days will be required extra and I'll be taking 1,000 only. There will be no discount. For you. 1,000. Previously also I charged 1,000 and this time also I'll be charging 1,000. No discount. Even if you are giving me additional work, I will not be giving you any discount. Since there is a new service associated and there is no discount, obviously these two are separate contracts. Factory building is a separate contract and office building is a separate contract. That is treated as a separate contract. This is the first point. That means if there is a new service, and there is no discount, I will not give you any discount for the new services. That means if you have taken SCM lectures from me, right? And even if you are taking CFR lectures from me, I'll tell you that I'm not giving you any discounts, and therefore this is not a new service. This is a new service and there is no discount. I'll treat it as a separate contract. SCM was separate, CFR is separate, like this, right? Moving ahead. Now, example 2, very important. Please pay attention. Original contract, it was 40 days, 1,000, right? 40 days, 1,000. And after 25 days, it is obviously I have booked 1,000 per day, 1,000 per day. That means after 25 days I have worked, right? 25 days I have already painted the factory building, right? So in that scenario, I must have booked 25,000. And now, after 25 days, there was a modification. You told me to also paint the office building, but this time you told that I'm giving you extra contract, office building. You have only painted the factory. 25 days I have already paid you, right? So give me some discount. So at that point of time, I told you, okay, I'll charge you only 800 per day. Now, can I say it was because of the previous contract that I gave you a discount? The answer is yes. So is there a new service? Yes, there is a new service. And is there a discount offered on a new service? The answer is yes. See, if there is a new service and if there is a discount, if there is a new service and if there is a discount, what we have to do is we have to book revenue on prospective basis. I'll change the average. I'll change the average. Like, see, 25 days already passed, right? So I've already booked 25,000. This is absolutely correct. This is not incorrect. This is absolutely correct. Now, what is remaining in this? What is remaining in this? Can I say 15 days are remaining? So for the 15 days, can I say the income was 1,000? Yes. So the total income will be 15,000. So total income will be 15,000. For the new contract, which we have received, it is 20 days into 800. That means I'll be getting 16,000. Yes. So that means I'll be getting total of 31,000 from now. For how many days? For 35 days. 15 days for the previous contract and 20 days for the new contract, right? That means the average of 31,000 divided by 35 will give me 885. So this will be charged from the 26th day. That is, I'll be booking the revenue as 885.71 per day because of this new service. Because I gave this new service at a discount rate because there was previous relationship, right? There was a previous contract which was ongoing. And if there is a new service at a discount, it will be treated as prospective. What do you mean by prospective? Right from now. You don't have to change from the previous, that is previous 25,000 was booked, it was correct. You don't have to make any changes to this 25,000. So prospective means right from now. Retrospective means from the beginning. That is, you have to change the previous figure also. In this scenario, you will not change any figure. This is known as prospective accounting, right? But the important is the third point. Important is the third point. Over here, the original contract was 40 days, right? After 25 days, I've already booked 25,000. Now, on 26th day, X Limited asked for additional 5 days at 600. That means I told them, we are the X Limited, right? I told them that in 40 days, I won't be able to complete the factory painting. I will need 5 more days. What you do is, since it is a delay from our end, you pay us only 600 per day. Now, please tell me, is there any new service? The answer is no. Are we modifying it? The answer is yes. So what we'll do is, we'll do this as a retrospective accounting. Now, retrospective in this IND AS is known as cumulative catch-up. The name is cumulative catch-up. Basically, it is nothing but retrospective. Now, what we have to do exactly, right? So, if there is no new service and if we are giving them discount, no new service, there is a modification in the previous service and at a discounted rate. So, what we have to do is nothing but cumulative catch-up accounting. That is nothing but retrospective accounting. Now, what is exactly retrospective accounting? So, what we have to do is, we will think that we knew this from the day one. We knew this from day one that this is going to happen. We'll consider like this, right? Obviously, I got to know this after 25 days. But we'll consider this. We'll consider it as we knew this is going to happen on day one itself. Now, what was the point? So, obviously, I'll be charging 40,000 into 1,000, that is 40 days into 1,000 is 40,000. And for 5 days, I'll be charging 600, that is 3,000. That means, in total, I was charging 43,000 for 45 days. That means, per day, I was charging 955.56. It was from day one, I'll assume that, right? It was from day one. So, in the previous 25 days, what was the revenue booked? It was 25,000. But from 955, you should have only booked 23,889. That means it is time for reversal now. It is time for reversal. So, revenue to be reversed is 1111. You need to reverse the revenue. That means it is nothing but sales account debit. That is revenue account debit. You need to debit the revenue again, right? And book from 26th day again 955.56, 955.56 and so on. That means this question was very important. So, to sum up, I'll give you the 3 points again, right? If there is a new service, but no discount, this is a separate contract. This is a separate contract. It will not be mixed with anything. Okay. If there is a new service, but with discount, so I'm adding up the services, but with certain discount. At that point of time, obviously, I change the average. That is remaining portion plus new. This I'll take the average and book with prospective effect. That is, I'll not be changing the retrospective. I'll start booking the new revised average from now only. But if there is no new service, but at discount rate, service is not new, the old service itself, I will just extended the days and we are giving the discount rate, right? At that point of time, what you have to do is, you have to take the retrospective accounting. Retrospective over here, is known as the cumulative catch-up. Now, what do you mean by cumulative catch-up? It is nothing but retrospective, right? What we have to do, consider this, that you knew that this 5 days will be extended at rupees 600 on day 1 itself. So from day 1 only, you should have booked at 955.56. You should have booked, but you did not book. You booked at 1000, right? So it is time for reversal. So whatever 25 days, that is 25,000 was booked, you have to just check how much should be booked at the revised rate, and whatever the extra booking was done, you should reverse the revenue, right? So I hope the point is clear. Now, I have also taken one more example. Over here. Question number 9 from our book. Growth Limited enters into an agreement with a customer for infrastructure outsourcing deal. Based on its experience, Growth Limited determines the customizing the infrastructure will take approximately 200 hours in total to complete a project, and the charges are 150 per hour. That means 200 was the initial estimate and 150 per hour was a new one. Okay. After incurring 100 hours of time, that means 100 hours have been already spent. So can I say 100 into 150? You have already booked the income, that is 15,000 income has already been booked, right? Every hour you must have booked the income. Now, Growth Limited and the customer agree to change an aspect of the project and increase the estimated number of labor hours by 50 hours at the rate of 100 per hour. Now, please tell me, is there a discount? The answer is yes. Okay. Is there a new service? The answer is no. Why? Because they are only modifying, increasing the estimate of labor hours. You just modified it. That means, can I say this is nothing but no new service at a discount? That is the third scenario. It is nothing but you have to check the cumulative catch-up basis, right? So how will I check? See, initial contract was 200 hours at 150, right? And the modification was nothing but 50 hours into 100. That means I knew on day 1 this is going to happen. We will consider it like this. You knew on day 1 this is going to happen. So you should have booked the income at 140. That is the average. 35,000 divided by 250. That means you should have booked at 140. But this was not the case. You already booked at 150, right? So can I say for 100 hours you should have booked at 140. That is 14,000 only. But you mistakenly booked at 150. That is 15,000. So 1,000 needs to be reversed. This is the scenario. So I hope this point is clear. Now, we are done with the first part. Of the 5 steps, we are done with the first part, that is C, that is contract, right? So what are the terms? I have given a summary over here. Please pay attention. Please pay attention. Contract. If we are checking the step 1, we have to check the contract. Now, what is contract? All the conditions must be fulfilled. When I say all, it is ARCTC. Approval, rights, commercial substance, terms, and its collection. That is, all the 5 points should be done, right? You can write in your own words also. You don't have to write the proper IND AS language. You can write ARCTC. Obviously not ARCTC. It is just a memory technique. So you just have to write the important words over there. You can write in your own sentence, but these words should be there. A is approval, R is right, C is commercial substance, T is terms, and C is nothing but collection, right? Every term will be, all the conditions are satisfied. At that time, it will be set as a contract, right? Now, contract term, it can be 3 years, 5 years, 7 years, 8 years, 10 years over the period, but we have to check the penalty. If there is no penalty for cancellation, obviously the term cannot be extended. You have to consider only 1 year, because after 1 year you will be able to cancel without any penalty. So I'll consider at 1 year. If there is a penalty, heavy penalty, then I can say it is 3 years, 5 years, or 7 years, whatever the case is, right? Now, next is modification. There were 3 cases of modification, right? 3 cases. What were the 3 cases? There is a new service but no discount. That means, can I say you are adding up a service but I am not giving you any discount? So if there is no discount because of the previous relation, at that point of time it is a separate contract, right? Separate contract. So this booking will be different, this booking will be different. Treat it as a separate contract. Okay. New service with discount. There is a new service, and because of the old relation, I am giving you a discount for the new service, right? At this point of time, what you have to do is remaining period, whatever the remaining life of the previous one is there, and plus add up the new thing. Prospective. From now, change the amount. Previously, what has happened, just keep it like that only. From now, you have to change. That is prospective. But the important is third one. There is no new service. Only the old service was there, but you just made a modification at a discounted rate. At this point of time, you will consider this. You knew this is going to happen on day 1 itself. At that point of time, you have to change retrospective, that is cumulative catch-up basis. Now, this was step 1, that is contract, right? Step 1, contract. So over here, if you can check, situation 3 was very important. Situation 3, as I told you, of the 5 steps, first 2 steps are theoretical, not very important. But if you want to consider a point, only this situation, that is situation 3, is considered as important in case scenario 1, right? So we are done with the step 1. Let's move on to step 2. Step 2 was nothing but P, that is CPTAR. We are already done with C, that is the contract. The second part is P, that is performance obligation. Now, what do you mean by performance obligation? In the example which I have already explained it when I started, there were 3 performance obligations. What were the 3 performance obligations? I want to perform. I have to provide you internet service over the 12 months period. I also have to provide the router. I also have to provide the installation, right? So there were basically 3 performance obligations. So in this scenario, you have to check what all you have to perform. What have you promised to transfer? Have you promised to transfer some goods, or have you promised to transfer? Have you promised to give some services? What do you want to perform in this entire contract, right? So basically, performance obligation is a promise to transfer to the customer either a good or a service, or a bundle of goods or service, either one good or more than one, right? That is distinct. Obviously, it should be one was the internet service, one was router. They are properly distinct, right? A series of distinct goods and services that are substantially the same and that have the same pattern of transfer. For example, audit fees. Audit fees. It is a series of distinct goods and services. Each and every time you have to file the audit reports, right? But each and every time the series is same. I'll be paying you, but each and every time it will be different reports, right? It will be different reports. So substantially the same. They have the same pattern to transfer, but they are still distinct. So at that point of time also, it is known as a performance obligation, right? Next. At the contract inception, an entity shall assess what you have to assess: the goods or services promised, and shall identify the performance obligation under each promise. So whatever the promises are there, you should first assess that and then move ahead. Now, there are distinct performance obligations. How to recognize if both the conditions are met, if both the criteria are met? So basically, there is a 2-step model. How do I check the performance obligation? How do I check the performance obligation? First, the focus on whether the goods or service is capable of being distinct, whether you can make it a distinct format or it is attached with someone. Second is focus on whether the good or service is distinct in the context of the contract. So basically, you just have to check they are distinct or not. If you are able to bifurcate them, like for example, I give you the example, router was different, installation was different. These are 2 performance obligations, right? So if they are capable of being distinct, then it's okay. If not, then in the context of the contract. Okay, moving ahead. Are there multiple promises of goods or services which are distinct? In the scenario, in the example which I gave you, yes, the answer was there were multiple promises, right? The service, the router, and the installation. If it is yes, it is known as multiple performance obligation. If the answer is no, it is a single performance obligation. So for performance obligation, if there comes a short note to write something on performance obligation, whatever is given right now, you just have to read it and present it in your own language. So basically, it is nothing but a promise to transfer. A promise to transfer. It can be a single product or it can be a multiple performance obligation, right? Okay. So over here, performance obligation can be either single or multiple. Can be single or multiple. So when to check? How to check whether basically it is simple or multiple? So when control is transferred to the customer, obviously it is known as single. As soon as I perform that, the control came to you. But if it is multiple, as and when the PO satisfies, that is the performance obligation gets satisfied, I can book the revenue. That is performance obligation. So a few more examples on performance obligation. For example, promises to transfer single goods and services. If I am promising to transfer only single goods, for example, transfer of machine or providing consultancy services, at that point of time, recognize the revenue when the control of goods and services are transferred. That means if I gave you the machine, I can book the revenue. I gave you the machine, that is you purchase the machine, I gave you the machine. Can I book income? The answer is yes. Okay. Next. Promise to transfer bundle of distinct goods and services. So basically, I gave you a car with 3 free services. So I told you, you can take a car and I'll be giving you 3 free services. So do you feel these are free? The answer is no. Obviously, this is added to some amount to the car itself, right? So in that scenario, obviously I need to bifurcate on the SSP, that is standalone selling price. For the car, obviously I performed. I have already performed my obligation. I have gave you the car. So can I book the income for car? The answer is yes. But can I book the income for this services? The answer is no. Let's say I gave you a service for every 6 months, 6 months, 6 months, and 6 months. For 18 months, that is I'll be providing a free service. So after 6 months, if you come or do not come, it doesn't matter. If you are coming for a free service, obviously I'll be providing that it is an income. If you are not coming, then also it will expire, it will lapse. It is an income for me. Obviously, it was free, but actually it was free for you, not for me, right? So I have already charged some amount to the car itself. So basically, recognize the revenue, that is sale of car at the time of delivery, and recognize sale of car services only when the services become due. So after 6 months, I can book revenue and so on. I've also given an example, so I'll be discussing that also, right? Okay. What if the series of goods and services are there? For example, a 3 years maintenance contract each year is distinct. So it is treated as a single performance obligation provided over the contract period. Revenue is recognized on SLM basis and on some reasonable proportion, right? So basically, if it is a 3 years maintenance contract or the audit fees, so basically, are they treated as a separate POs? The answer is no. They are single POs only. For example, if you are giving a professional fee to a CA or a CMA for the filing GST returns, right? So at that point of time, GST obviously each and every time they have to they have to file for every month, right? But is it a separate performance obligation? The answer is no. It is a single PO, single performance obligation, and you can book revenue on the basis of monthly, that is SLM basis or some reasonable proportion if there is any better idea having with you, right? So at this point of time, with the performance obligation, you just have to check whether it is a single or a multiple. Basically, one time or multiple times. So what you have to consider is nothing but performance obligation. So we are done with step 2. So basically C and P we are done. These were basically theory points. The only important point in this was the modification part, the third situation, right? That is the cumulative catch-up basis. From these two, I prefer only the third situation. Now, the actual IND AS will start from now. The actual IND AS will start from now. And that is determine the transaction price. We are moving to the third step, that is CPTAR. I'll repeat once again. C was the contract, P was the performance obligation, T is the transaction price, A is allocation, and fifth is revenue recognition, right? That is recognized revenue. So basically, we are on to the third step now. This is one of the very important step. Now, what is T? T means transaction price. What is transaction price basically? The transaction price is the amount of consideration that an entity expects to be entitled in exchange for the transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties such as GST. For example, if I'm making a sale, so the entry becomes bank to sales, right? Bank to sales, this is the basic accounting entry, and to output GST also. To output GST. For example, I received 11,800, 10,000 was the sale amount, and 1,800 was the GST amount. So can I say only 10,000 is my income? The answer is yes, because even though I have collected 1,800, this is not my income. I have taken this GST and I have to pay this on your behalf to the government, right? So this is not my income. This 1,800 cannot be treated as income. The amount of income can be only 10,000. Okay. What if the amount has not been received yet? It says status. Can I still book the income? The answer is yes. You can still book the income because cash sale or credit sale, it hardly matters. You have to book the income of 10,000. That is excluding any amount paid to the third parties, that is GST. Now, transaction price is not always the agreed contract price. Now, why is this so? Basically, I have agreed that, let's say, I'll give you an example. I gave you a contract to make a book for me. That is, I wanted to make some notes, but I was not having any time. So I gave you a contract. Let's make a book for me, right? So I'll pay you 50,000 for a book, for making some notes for me. I'll pay you 50,000, right? So you told me that it will be 6 months. You will take 6 months to for the complete book. I said okay, no problem, 6 months. But if you complete the book in 4 months, I'll give you 10,000 additional. I'll give you 10,000 additional. So can I say this is not very sure? So at that point of time, this 50,000 was very sure, right? 50,000. So in this agreed contract price was 50,000. But this 10,000 is also known as the variable consideration. So should I add this 10,000 or not? I'll explain you within the examples. But I'm just telling you the agreed contract price was 50,000. But over here the transaction price can be treated as 60,000 and not 50,000. So not each and every time the agreed contract price will be the transaction price. You have to check what is the transaction price in each and every scenario. So basically, as I told you, IND AS 115 actually starts from step 3. First 2 steps were very regular. Third, fourth, fifth are very important, right? So the transaction price. What is the transaction price basically? So the example which I gave you, there is 10,000. It was variable consideration, right? If you perform if you make the book in 4 months, obviously only at that point of time I'll give you. If not, then I'll not pay you, right? So this is basically variable consideration. Now, what is exactly variable consideration? I gave you an example. Let's discuss it and then move ahead. So basically, there are 5 points which we need to consider in transaction price. So I'm just making a chart now. So basically, we have completed a contract. in which I have completed 3 points: ARCTC, contract term, and modification. In modification also there were 3 cases: new service, no discount; new service with discount; and no new service with discount, right? So basically there were 3 cases. And now second was PO, multiple or single, and third is transaction price. In the transaction price there are 5 points. What are the 5 points? First is variable consideration. Now what is variable consideration? I've already explained you, and I have given 2 examples also. So I'm reading the example: variable consideration. Contract given to complete a specific task for a fixed consideration for 60,000 and the contract term is 6 months. The example which I gave you, let's say it was the contract was to make a book and I'm paying you 60,000 and the term is 6 months, right? Okay. If completed within 4 months, then bonus of 10,000. If you complete the contract in 4 months, the bonus will be 10,000. If completed beyond 6 months, then penalty of 5,000. That means if you will not complete, at that time, I'll charge you 5,000. Now, the transaction price, obviously it is not the agreed value was 60,000, right? But it will not be the transaction price. Agreed contract price was 60, the transaction price will be the fixed amount 60,000 plus any variable consideration. Now, what is variable consideration? We need to estimate. How to estimate? There are 2 methods. What are the 2 methods? First is the expected value method, that is nothing but multiply by the probability. And the second is most likely method. Most likely. We don't use probability in this case. There are only 2 outcomes. Now, what are these 2 cases? I'll explain you in detail. See, over here, there will be taken chances. Like for example, there are 60% chances of me completing in 4 months. There are 25% chances of of delivering in 5 months, and there are 15% chances of taking 7 months. That is, I'll delay. So please tell me, if I complete within 4 months, will I get a bonus of 10,000? The answer is yes. You will get a bonus of 10,000. If you complete in 5 months, obviously you will not get any bonus. But if you complete in 7 months, I'll charge penalty from you, 5,000. So this is known as expected value. That is multiplied by the probability. So how will I do? 60% of 10,000 is 6,000. And 15% of 5,000 is nothing but 750. Obviously, this is a minus. So I'll add 5250 to the agreed valuation. That is, this 60,000, I'll add 5250 as the variable consideration. That is the method of expected value. Now, but what if I have only 2 outcomes? Either yes or no. That is, I'll complete in 4 months or not complete in 4 months. And 70% chances are I'll be completing in 4 months. Right? Only 2 outcomes. 4 months or not in 4 months. That's it. So if this is the case, this is known as most likely. In this scenario, again I'm telling you, we will not use any probability. We will consider entire 10,000 as the amount. Entire 10,000, because the most likely amount, because I'll be completing in 4 months, 70% chances are there I'll be completing in 4 months. So I'll not take this 30%, I'll not take this 70%. What is the most likely? Will you complete? The answer is yes. The most likely amount is you will complete in 4 months, right? So at that point of time, I'll add entire 10,000 to the amount. So basically, when to use which method? How will you follow? How will you check? So basically, if there are only 2 outcomes, so we'll take the most likely. We'll not use any probability. I'll take the entire 10,000. But if there is any probability, at that time I just need to multiply with the probability. So basically there are 2 points: fixed plus variable, right? Fixed plus variable. So we are done with this first point. Actually, second point also is the same, considering estimates of variable consideration. So 29 and 30 were the same. So these are the points. I'll be again taking one more example of this. Estimating variable consideration. Read the question properly. XYZ Limited enters into a contract with a customer to build sophisticated machinery. Okay. The promise to transfer the asset is of the performance obligation that is satisfied over time. The promised consideration is 2.5 crore for a machine, right? For a machine, 2.5 crore. But that amount will be reduced or increased depending upon the time of completion of the asset. That means I can either increase or decrease this amount depending upon the completion. When will you complete? Okay. Specifically, for each day after 31st March, that is, if you delay it after 31st March, the asset is incomplete, the promised consideration is reduced by rupees 1 lakh. That means I'll be charging 1 lakh rupees penalty per day. That means if I have given you a contract of 2.5 crores, deliver the machinery till 31st March. As soon as you start delaying from 31st March, if you deliver it on 1st April, I'll give you only 2.549 crores. That is 1 lakh I'll reduce from the contract price, right? Okay. For each day before 31st March, that the asset is complete, the promised consideration will increase by rupees 1 lakh. And if you deliver the machinery before 31st March, so how many days were there before 31st March? I'll provide you 1 lakh rupees extra, right? So if you give me before 31st March, 1 lakh is the extra per day. If you give after 31st March, 1 lakh is the per day extra charge on you, right? Okay. In addition, upon completion of the asset, a third party will inspect the asset and assign a rating based on the metrics that are defined in the contract. If the asset receives the specific rating, the entity will be entitled to an incentive bonus of rupees 15 lakh. So if at all we get this rating, I'll be getting a 15 lakh rupees bonus for the extra point, right? Now please tell me, is the probability point given to you? The answer is no. So in this scenario, you will give both the answers. If you have the probability answers, that is expectations, you will multiply the answer. And if you don't have any expectations at that point of time, you will consider this as the most likely or not, right? So basically over here, I have given the 2 points, please check. Now, if I check this point, can I say there will be a probability associated with it? How come? See, obviously you will take chances, right? I'll be completing like 5 days before, there are 5 days before, okay? 5 days before that, there are chances of 10%, right? Okay. Of me completing 4 days before, there are 12% chances. Of me completing 3 days before, there are 15% chances. Of me completing 2 days before, there are only 10% chances. Of me completing 1 day before, there are only 5% chances, and so on. 0 day, that is on 31st March itself, there is 5% chance. I'll delay by, I'll delay by 1 day delay. The chances are 10%, and so on. So obviously, what I have to do is, over here, I'll be getting 5 days, that means 5 lakh rupees. 4 days, that means I'll be getting 4 lakh rupees. For every 1 day, I'll be getting 1 lakh rupees, right? So I just need to multiply with the probability and add that variable consideration to this 2.5 crores. So basically, if there is increased or reduced for a number of days, obviously I'll be taking the estimated price. That is, I'll check the probability, expected value, right? But over here, 15 lakh rupees. Obviously, either I'll get that 15 or I'll not get that 15. Is there any chance there are 10% chance of me getting 10 lakh rupees or 12% chance of me getting 12 lakh rupees or so on? There is no point in that, right? Either if I get the asset, that is, if I get the rating, I'll be taking 15 lakh rupees. If I do not get, obviously I'll not get 15 lakhs. So obviously there are only two outcomes. Either you will get it or not get it, right? So obviously you will check the most likely. In this scenario, I'll not multiply the answer by 70% or 80%, whatever the scenario is. For example, if there are 80% chances of me getting this specific rating, so at this point of time, this 15 lakh rupees, I'll not multiply by 80%. I'll take 15 lakh rupees as the entire variable consideration, right? So this is the point. So over here, this is only written expected value method is the best for this one, 1 lakh, 1 lakh. And for this 15 lakh, most likely amount, only two possible outcomes, 15 lakh or nil, right? So most likely is the best answer. So I hope you got this point, variable consideration, right? One more example on variable consideration. I'm just reading out, please pay attention. AST Limited enters into a contract with a customer to build a manufacturing facility. The entity determines that the contract contains one performance obligation satisfied over time. Construction is scheduled to be completed at the end of 36th month for an agreed upon price 25 crores. That means the agreed price is 25 crores and the total days are total duration is 36 months. Okay. The entity has the opportunity to earn a performance bonus for early completion as follows. That means 15% bonus for the contract price if completed before 30th month. That is, if at all before 30 months, 36 months is the contract. If I complete the building, if I complete the construction within 30 months, I'll be getting a 15% bonus. And there are 20% likelihood, that is 25% probability. Okay. 10% bonus if completed within 32nd month. So 40% are the chances. 5% bonus if completed by 34 month and 15% chances. So can I say 25 plus 15 is 40, 40 plus 40 is 80. 20% chances are there, I'll be getting no bonus, obviously, right? So can I say expected value method is the best method over here? Expected value method, the answer is yes, expected value. So how to calculate? See over here, 15% is the bonus. So what will be the bonus amount? Obviously, it is 15% of what? Of the contract price. The contract price is 25 crores. So 15% of 25 crores comes to 3.75. What are the chances? 25%. Just multiply the answer. Just multiply the answer. So this we are calculating the consideration, right? The variable consideration. Okay. 10% that is 25 crores. 10% is 2.5 crores. 40% for the chances given. Just multiply the answer and you will get 1. Just multiply the answer and you will get 0.875. And 0%, as 0 bonus, obviously 20% for the chances 0. So the answer comes to 2.125. So the answer comes to 2.125. So over here, what is the fixed consideration? fixed is 25 crores and the variable consideration is 2.125 is 2.125. So what is the transaction price? The transaction price comes to 27.125 and not 25, right? So because there was also variable consideration attached to it. But this is not the case. There is one more scenario. In addition to the potential performance bonus, after completing this also, there is one more bonus. AST Limited is entitled to a quality bonus of 2 crores if a health and safety inspector assigns the facility a gold star as defined by the agency in terms of the contract. AST Limited concludes that 60% is likely that it will receive the quality bonus. That means, can I say most likely is that I will be getting a bonus. So, can I say the approach over for this 2 crores should be the most likely approach and not the estimated, that is expected value approach, because there will be only two outcomes. Either you will get 2 crores or you will not get 2 crores, right? So, this 2 crore entirely will be taken. I am again telling you, will not use the probability over here. When we check the most likely case, either add up the 2 crore or don't add up. So, what will the case? The answer will be 2 crores additional, because the most likely 60% is most likely, right? So I'll add up 2 crores directly. I'll not multiply with the probability. So I hope the point is clear till here. So this was the case of variable consideration. Okay. Now coming to the third point, significant financing component. Now what do you mean by significant financing component? See, over here we have to check the interest. Finance means interest, right? Over here we have to check the interest. So what is the transaction price? It should be excluding interest. It should be excluding interest. For example, I went to a let's say Vijay Sales or Chroma. I went to Chroma and I told them, give me a laptop, right? I purchased a laptop and I told them I'll pay you after 1 lakh. I'll pay you 1 lakh after 1 year. Obviously, this is year 0 and this is year 1. I'll be paying 1 lakh over here. So can I say, obviously, not give directly for 1 lakh. If I pay the cash price over here, it'll give me certain discount. So obviously, this price will be treated as the transaction price, not the 1 lakh. Although I'll be giving you 1 lakh rupees, but that 1 lakh was not of the laptop. The laptop was the current present value. When the delivery was given at that time, what was the rate? So let's say, example, it was 90,000. But since I told you that I'll be giving you after 1 year, so the price becomes 1 lakh. So is the contract price 1 lakh? The answer is yes. But can I say the transaction price is only 90,000, because this 10,000 will only be the interest cost, right? So over here, significant financing component. Reliance Digital. Let's say we are Reliance Digital, the seller, and we are selling a laptop. So basically, if you pay right now, you get 1 lakh rupees. And if you pay after 1 year, you have to pay 1.2. So I cannot say the laptop cost is 1.2. Obviously, the revenue is 1 lakh only. Reliance will get 1.2 after 1 year, right? But can I say 1.2 is not the income right now? They have just given a laptop 1 lakh, right? So they can book revenue of 1 lakh rupees. For example, receivable, that is data account debit to sales. Data to sales of only 1 lakh. This 20,000, that is 0.2 lakh, is nothing but the interest. So what I'll be doing is, at the end of the year, I'll be charging interest. Interest is my benefit, that is income. Interest should be credited, and I'll be charging from that data only, receivable to interest. And then after 1 year, I'll be taking this 120. So the point over here is, you can take revenue, and this is also interest. Interest is also the revenue that is charged to P&L. But the point is, what amount of revenue should be booked? So the point, the rule is, whenever you deliver, what was the amount you will pay at that point of time? And that 1 lakh is the answer, right? 20,000 will be treated as the finance cost. Okay, moving ahead. Thumb rule. Okay. Second, Reliance Digital. If he is the seller, laptop is customized. Since it is customized, I obviously will take some time. That is, I'll tell you, I'll pay you after, make a laptop for you after 1 year. So delivery after 1 year and payment on day 1, but you have to pay the advance right now, 90,000. So is this 90,000 the agreed value? The answer is no. The transaction price will not be 90,000. Why? I haven't delivered this. When I'll deliver after 1 year, obviously at that time the cost was 1 lakh rupees. But since I'm taking it right now, it will be treated as cash discount. That is nothing but again the financing component. So over here, you gave me 90,000 right now. I'll not consider as sale, because I haven't given the laptop right now. It is nothing but advance income for me. Bank to advance income, right? After 1 year, interest is nothing but the expense for me now, because I've taken the advance from you. I have to pay interest to you, right? Since I haven't given you any laptop, the laptop was actually for 1 lakh. But since I've taken this amount 1 year ago only, at that point of time, this 10,000 is nothing but the interest cost. Ideally, we say it is a cash discount, but in terms of IND AS, it is nothing but finance cost, that is interest. to advance income, and after 1 year, advance income to revenue. That is, whenever I will deliver, whatever the price at that point of time is, I'll consider that as the transaction price and not the amount, right? So this was the third point, if it is significant component over here. Yeah, significant financing component, right? So we are done with the two important points. First is the variable consideration. Variable consideration, we have two methods. What are two methods? First is expected value method, and second is the most likely method, right? And for significant financing component, either you can make a payment early or you can make it a payment at a later date, right? At that point of time, the important point over there is whenever the delivery is done, at that point of time, whatever the amount is, that is will it as the transaction price, right? Okay. Moving ahead, I've also provided with a few questions for significant. Yeah. So basically, there are a few exceptions for significant. Just give me 1 minute. Okay, moving ahead. So basically, there are a few exceptions for significant financing component. What are those exceptions? Customer paid in advance, but the timing of the transfer of goods and services is at the discretion of the customer. See, you paid me in advance and you took a prepaid voucher or a gift card. Let's say you have taken a gift card from the Amazon, right? You have taken a gift card and the validity of that gift card is 1 year. Obviously, you paid Amazon the entire amount. Let's say you have taken a 10,000 voucher, a gift card for 10,000, and you gave it to someone. You gifted it to someone. I'm not talking about that someone. I'm talking about Amazon. Can I say Amazon can book the entire 10,000 as revenue on the first date? You will say, sir, Amazon has not performed that obligation, but that was not depend upon Amazon, right? It is upon you. When will you purchase that? It is not upon you. So basically, when the customer paid in advance, but the timing of the transfer of goods and services is at the discretion of the customer. That is not depend upon the Amazon, right? Over here, when I was delivering a laptop to you, it was in my hand to deliver after 1 year because it will take to customize, right? Whatever your specifications are there, it will take 1 year for me to complete that performance obligation. It was depend on me. But at this point of time, when it is a gift card or a prepaid voucher, it will depend upon you whether to exercise or not, whether to to make purchase it right now or after 1 month or after 2 months or after 6 months. So it depends upon you. It was not in my hand. So I'll book the entire revenue right at the first day itself. I'll not treat it as a significant financing component, right? Second, a substantial amount of consideration is variable based on future events that is not within the control of the customer. For example, consideration is based on sales-based royalty. Now, what is this point? Uh, for example, I wrote a book. And I don't know what will be my income because I'm just the author. I wrote a book. Publication and marketing is not my task. Publication will be certain publication company or something. They will publish my book, and obviously whatever the amount is, they'll pay me royalty on some sales amount, right? So can I say I have taken a contract with them that you will pay me royalty as of certain percentage on that book each on whatever the sale amount is, but I don't know what will be the sales right now. So will I be able to book right now? The answer is no. So if you don't have that amount and you are delaying it, it is not a significant financing component. You are not delaying it because you don't know the amount, and that is why the delay is, right? Third point, difference between promised consideration and cash selling price arises for reasons other than the provision for finance. For example, I don't have trust on you. For example, you are a certain person and I did not get any good report from the market for your business, right? So before selling only, I told you, no, you have to pay advance, only then I will order goods for you, right? You have to pay advance. So this is not because I wanted advance income. This is just because your name or fame was not very popular in the market, and since no one was giving me a good report, I asked for an advance. So that is basically not a financing component. That is other reasons, right? And the fourth point is difference between the delivery and the payment is less than 1 year. So if it is less than 1 year, the IND AS says you don't have to discount it. So you can consider the same price itself, right? So you don't have to take the interest cost at that point of time. These are exceptions to it, although not very important, but still I have discussed it. Important point was at what amount you will take. If you are taking advance income, obviously you will have to discount it. If you are taking a delayed income, you have to exclude the interest amount, right? Now, whether it is significant or not, you just have to consider over here. See, by looking at the question itself, you will be able to answer for sure. For example, question number 37, a commercial airplane component supplier enters into a contract with a customer for a promised consideration of 70 lakhs. So basically there is a contract and the contract is for 70 lakh rupees. Based on an evaluation of the facts and circumstances, the supplier concluded that 1,40,000 represented an insignificant financial component. Insignificant. They have clearly mentioned. So basically 140 is how much percentage of this? Can I say 2% only? For 70 lakh, 140 is nothing but only 2%, right? So, and that's why they told that it is insignificant. Because of an advance payment received in excess of a year before the transfer of control of goods. State whether company needs to make any adjustment to determine the transaction price. The answer is no. Since it was insignificant, you don't have to consider any interest on that, right? So basically, if at all you are providing any services after 1 year, and if you are getting 1,40,000 as an advance income itself, at that point of time also you don't have to consider any interest. You have to consider 70 lakh as the transaction price itself, because 1,40,000 is negligible, only 2% of the contract. But if it was 14 lakh, if the advance payment was larger and it was 14 lakh, is it significant? The answer is yes, because it will now turn to 20%. So do you have to make any adjustments to it? The answer is yes. You need to adjust it. That is, you have to check the interest financing component and subtract whatever the amount is, right? So this is important. So over here, if you can check, rupees 14 lakh represents the financing component, is significant, and you should adjust the consideration. And you have to adjust the consideration. That means you have to check the present value of that amount, right? So over here, you just have to write a few sentences on that, whether it is significant or not. So you can say 1,40,000 is just 2%. It is not significant, and you don't need to adjust. 14 lakh is a significant amount, and you need to adjust. When I say we need to adjust, that means we need to bifurcate the interest amount, and we just have to take the present value of it, right? So these are the points, right? Okay. Next point, again, there's one more question. It sells a product for 121, which is payable after 24 months after delivery. That means if I am delivering you the goods right now, you will pay me after 24 months. Can I say 1,21,000 is also considering some interest? इसके अंदर interest भी है और इसके अंदर principal amount भी है, right? So this principal amount will be treated as the revenue, and this interest will be booked over the period, right? So 121, and they have clearly given the cash selling price of the product is 1 lakh rupees. That means if you sell it right now, you will get only 1 lakh rupees. So you need to book revenue of 1 lakh only, not of 121, right? Even if the contract price was 121, my transaction price will be only 1 lakh. And the rate implicit is 10%. Obviously, as per IND AS 109, the implicit rate is 10%. So even if you check 1 lakh plus 10% will give you 1,10,000. Again, plus 10% interest will give you 1,21,000. So this is how they calculate the amount. They just added 10% interest each and every year for 2 years, right? Okay, moving ahead. Okay, next is determining the discount rate. Now, what is exactly the discount rate? Just 1 minute. Yeah, VT Limited enters into a contract with a customer to sell equipment. Control of the equipment transferred to the customer when the contract is signed. The price stated in the contract is 1 crore plus 10% contract rate as an interest payable in 60 monthly installments of 212,470. Now, what they have done is they have taken a contract of 1 crore plus a 10% contractual rate of interest, 60 months, and they will be paying 2,12,470 as an installment. Okay. Determine the discount rate and the transaction price when. Contractual discount reflects the rate in a separate financing transaction, and the contractual discount rate does not reflect the rate in the separate financial transaction, that is 14%. See, over here, if you can closely watch, contract rate is 10% and the delivery day price is 1 crore. They have clearly given 1 crore, right? So can I say this 1 crore is the transaction price and the market rate is 10% in separate financial transactions. So over here, when I'll deliver, the price is 1 crore. I'll be taking that transaction price. Basically, if it reflects in a separate financial transaction. If it does not reflect, then I'll take the market rate discounting. Over here, you can check. Contract rate is not equal to market rate. Contract rate was 10% and the market rate was 14%. So obviously, if they are not equal, what I have to do is I have to take the present value of the future cash flows. So transaction price will be the present value of future cash flows at market rate. So if the 212,740 annuity factor of 60 months at 1.66%. How come I took the 1.66? It is 14% divided by 12 months at 1.66. So if you calculate the annuity factor, it will come to 42.97701. It will be given to you, so you do not need to worry. And the total amount comes to 91,31,327. So out of this 1 crore, 91 lakh something amount is the revenue amount, and the rest amount is being treated as the interest amount. So basically, how will I consider the discount rate? So basically there are 2 points. Your market rate will be equal to contract rate. At that time 1 crore directly you can take, but if the contract rate is not equal to market rate, at that point of time, what will be the transaction rate? It will be treated as the present value of future cash flows. Present value of future cash flows at market rate. So if you check the contract price over here, right? I've taken all the 3 points over here. I've also considered discount over here. How to consider the discount rate, right? Also, I've given the summary again. 2 points left are non-cash and consideration payable to customer. We are still on the third point. As I told you, the IND AS is a bit lengthy. IND AS 115 is a bit lengthy. We are still on the third point itself, right? We haven't completed the fourth and fifth point. Third point again is very important. Okay, moving ahead. Yeah. Yeah, this one. Non-cash transaction, that is exchange. So basically, if I'm, this is barter system, just as in PP. So if I'm giving you something and if I'm taking something from you, at that point of time, what will be my sale treated as? So in this scenario, it is a reverse case of IND AS 16. I've given an example, just pay attention on this example. We are X Limited and we sold goods to A of rupees 10,000. For example, let's say, I'm providing you SM or CFR lectures, let's say CFR lectures for 10,000. The amount for the fast track batch is 10,000, right? For CFR. And you are Mr. A. But you are also working in a firm. So I told you, just file my returns. Just file my GST and income tax returns, right? And don't pay me for this and I won't pay you for that. So can I still book revenue? The answer is yes. I need to book revenue and also need to book an expense for audit fees, right? At that point of time, I will check. I will not say this 10,000 is my sale, because if you are filing my returns and if you are providing me services, so what is the amount of services you are providing? Let's say GST and income tax returns will charge only 8,000. You will charge only 8,000, but I told you, okay, that's completely okay. You are still my student. Take the CFR lectures and file my returns, right? At that point of time, I will not book revenue of 10,000 since the CFR was 10,000. No, I'll book revenue on the fair value of goods or services received and not given. It is completely reverse of what we learned in IND AS 16, that is PP. How to book the exchange transaction? In that scenario, it was fair value of asset given up. We are not giving up. We are actually giving up the goods, but we don't have to record like this. We have to consider as the fair value of assets received, right? So basically, whatever I'm receiving, whatever the fair value is, I'll book revenue on that. That means I'll say I sold CFR lectures for 8,000 and not for 10,000 because I got only 8,000, right? So this is the scenario. So even if you look at this P&L, by revenue, I'll be booking only 8,000 or 10,000. That is fair value of goods or services received. So if there is exchange, I have to take the fair value of the goods or services received and not the goods provided to you, right? Okay. Consideration payable to customer. Now, what is consideration payable to customer? Customer provided. So basically, again, there are 4 to 5 points in that. Consideration payable to customer. That means we are only paying to the customer. Why will I pay to the customer? Basically, customer should pay me, right? If you are my customer, you will pay me. Why will I pay you? So there are basically a few cases over there. So first point, if you are the customer and I am Gold Limited, my company's name is Gold Limited. Now, you wanted a gold chain of 12 lakh, but you told me that you will provide me the gold biscuit of 10 lakh, and from that gold biscuit only, I'll give you the chain of 12 lakh rupees. That means you have to pay me only 2 lakh. Only 2 lakh. So now over here, what revenue should I book? Should I book a revenue of 12 lakh because I'm giving you a chain of 12 lakh? Or should I book only revenue of 2 lakh because you are giving me only 2 lakh and 10 lakh is the gold biscuit? So what are the two cases? So in this scenario, I have to take two points of the Gold Limited. See, what I have to do is Gold Limited will book a revenue of 12 lakh and purchase of 10 lakh. That is, he will say, I have sold 12 lakh rupees gold chain and I have purchased 10 lakh rupees gold. If control of gold is transferred, that means the customer told me that this is the gold biscuit from my side. Do whatever you want. You have to give chain from this gold biscuit or from your shop. It hardly matters. You can give me a chain. So I'll say I have purchased a biscuit for 10 lakhs and I have sold the chain of 12 lakhs. That means if the ownership rights of the gold biscuit is with me, they gave me a gold biscuit and they told me whatever you have to do of this gold biscuit, you can do. You can make a chain from this biscuit if you want. If you want, you can make a chain from the another biscuit and so on, right? So at that point of time, I become the owner of that gold biscuit. I have the control, right? Whether I have to make the chain from that biscuit or from another one from my shop itself, that completely depends on me, right? So this answer will be on gross basis, not net of. That is, I'll not book of income of 2 lakh. I'll book revenue completely to 12 lakh and I'll make a purchase of 10 lakh. But what if the customer says, I want the gold chain from this biscuit itself, make in front of me right now. At that point of time, I haven't purchased it. I haven't taken the control of that asset because that gold biscuit is not belonging to me. I have to make it for you only. So I haven't taken the ownership of that gold biscuit. So at that point of time, I'll book revenue of 2 lakh only. That is on net basis. The contract does not transfer. Sorry, the control does not transfer. If control was not with me, I have to book it on revenue on net basis, right? So these are the 2 points: gross basis or net basis. Moving ahead. Second, does not relate to distinct goods or services. For example, cashback or voucher. This is one of the important questions. Okay, this one question was asked in the recent papers also, so you have to pay attention on this point. I have also taken that question itself. Okay, so it does not relate to distinct goods and services. That is cashback or voucher. For example, you went for a shopping. Let's say you went to West Side for shopping, and you purchase goods for rupees 5,000. Let's say you purchase apparels and clothing for rupees 5,000. So basically, they gave you a 1,000 rupees coupon, a voucher, which you can encash it if you purchase it further. If in, let's say, 50 days, in the next 50 days, you purchase for 3,000, you'll get a discount of 1,000, like this, right? So basically, this is voucher. So what we have to do in that scenario? Reduce the transaction price and show on net basis. So basically, what I'll do is, whatever the value of voucher is or whatever the amount of cashback is. For example, let's say you made a recharge. You made a recharge from, let's say, GPay, Google Pay, right? You made a recharge of, let's say, 666, and you got a cashback, that is GPay, that is from the Google, you got a cashback of rupees 16. That means ultimately Google Pay received only 650. Google Pay received only 650. So Google Pay can book the income of 650 and not 666. Why? Because they issued a cashback. And since this cashback, it should be reduced from the transaction price. The transaction price was 666, and you should book on net basis. That is Google Pay. From the point of view of Google Pay will book only income of 650 and not 666. This is one of the important point, right? Next, slotting fees. Now, what do you mean by slotting fees? You have to reduce from the transaction price and show on net basis. Now, what is exactly slotting fees? See, if this is LG company, we are LG company, right? And we are selling electronics of 50 lakhs to Chroma, and Chroma is one of the customer with us. So basically, I gave him goods of 50 lakhs. Obviously, they should pay me 50 lakh rupees. But I also told Chroma that I want the front entrance. As soon as the customer enters, the front wall should be of LG products only. I want that slot. You have to advertise LG products only, not Samsung, not any other product. You have to make, as soon as the customer enters, the first wall should display is of LG, right? All the LG products should come in front of them. At that point of time, obviously, this is slot. So Chroma will say, okay, if you want that advertisement, if you want that slot, you have to pay me something. That means it is payable to customer only. I am selling the products and I am only paying to them. That is, you give me that slot for advertisement. At that point of time, also provide 1 lakh for the first slot on entrance. At this point, again, it will be on net basis. That is, LG will not say, I have to book a revenue of 50 lakh. LG will say 50 minus this 1 lakh, because I also have to pay 1 lakh rupees, right? I give you the goods of 50 lakh, but you will not pay me 50. You will pay only 49, because 1 lakh is the slotting fees, right? That is the slot fees, right? So at that point of time, 49 lakhs will be booked as income for me. That is revenue. Next, cooperative advertising arrangements. Again, one of the advertisement point, but in that points, the IND AS says you have to depend on the careful analysis. Now, what do you mean by careful analysis? In the examination also, you have to write the answer like this only. Whenever it will be say advertising arrangement, at that point of time, you will say we have to make a careful analysis. Now, what are the careful analysis? I give an example. Please pay attention on the example. Let's say we are Nike Limited, right? And this is Shoppers Stop, the customer with us. We provided him the shoes of 20 lakh rupees. Nike sold the goods of 20 lakh rupees shoes. Shoppers Stop has the LCD is displayed over in each and every corner of their showroom, right? So we also paid them 20,000. Nike also sold 20 lakh rupees goods, and Nike only paid them 20,000 to to book an advertisement on its LED screen, just to play advertisements time to time basis, and that should be of Nike shoes only, right? At that point of time, what is the careful analysis? If the advertisement is of that shoes only, the shoes which we gave him, if the advertisement is only of that shoes itself, at that time I have to book revenue on net basis. That means I'll book revenue of 19 lakh 80,000 only, 20 lakh minus 20,000. But if the advertisement is of the whole Nike brand and not of the shoes, at that point of time I have to book the revenue on gross basis, that is 20 lakh income and then 20,000 as advertisement expense separately, right? That is gross basis. This is the point. Next. Okay, slotting fees. Over here, slot. An entity that manufactures, this is question number 52 from our book, okay? An entity that manufactures consumer goods enters into a one-year contract to sell goods to a customer, that is large global chain of retail stores. The customer commits to buy at least 15 crore of products during the year. That means total 1 year it will be buying 15 crore products. The contract also requires the entity to pay non-refundable payment of rupees 1.5 crores to the customer at the inception of the contract. 1.5 crores I also have to pay. That means the entity also have to pay a payment of 1.5 crores. The 1.5 crore payment will compensate the customer for the changes it needs to make to its shelving. That is, on the shelves they will be making 1.5 crores, they have to pay for that to accommodate the entity's products. The entity does not obtain any control of rights to the customer shelves. Determine the transaction price. See, over here the mistake made by the students is they say 15 crore minus 1.5 crore. Right, 15 crore minus 1.5 crores. You will say 13.5 crores. But it is for 1 year. It is for 1 year, right? So you have to take monthly. You just have to divide by 12 and take it on every month basis. So over here you can check 15 crores. That is for 1 month. It will be whatever the amount will be, right? And it will come to 1.25 crores. That is 1.25 and minus the 10% of the units. 10% is nothing but 15 crore, 1.5 crores, right? So at that point of time, divided by 12, whatever the amount is, you will book as revenue. That is 1.125 crores. This is every month. For the first month over here, it is clearly given to you, right? So this is nothing but slot fees. Slot, you have to make it on net basis. Okay. Next is price protection. Next is price protection. Now, what is price protection? Again, I have given you the example. We are Samsung. Samsung is our company, okay, and we have sold mobiles of 50 lakh rupees to the retailers with price protection. What is price protection? I gave them the right that if at all, the price drops below this certain limit. As soon as I gave you the product, let's say you are a retailer, I gave you 50 lakh rupees of mobiles, right? And obviously, there are a lot of fluctuations in the mobile rates. If the rate reduces in the market, let's say the rate comes to 48 lakh rupees, that means 2 lakh will be the loss for you. So I told you that within 3 months, if the price drops, I'll pay you. That is, Samsung will pay you back the 2 lakh rupees or whatever the loss is, whatever the price drop is. I'll pay you only after 3 months if you have that in stock. If you sold, obviously I'll not pay. If you have sold to the customer, obviously I'll not pay. If you have it with you, obviously I'll pay because that will be a loss which will be covered by the company. So in that point of time, I'll book the amount on net basis. This amount should be deducted from the revenue by Samsung. That is, I'll book on net basis 50 lakhs. Out of this 50, I'll be returning 2 lakh rupees to you, right? So that means Samsung will book revenue of 48 lakhs only, not of 50 lakh rupees. Now, we are done with step 3, and now it's a time for summary. See, there are a lot of points in this. There are a lot of points in transaction price. One of the very important point, right? So basically, what were there in transaction price? So basically, the first point we considered is the variable consideration. Now, what was variable consideration? Basically, variable consideration was nothing but if this happens, I'll pay you extra. I'll pay you something extra. If it does not happen, I'll charge you. So basically, we were having 2 methods for that. First is the expected value method. I just need to multiply the probability. And the second is most likely method, having only 2 outcomes. In that scenario, please don't multiply by probability, right? Please don't multiply. And if there is a constraint, that is, it is not doubtful, I may get or not get. At that time, if you're not very sure, don't recognize it, right? So expected value multiply by the probability. If only 2 outcomes are there, don't use probability. I'm again telling you, if only 2 outcomes are there, don't use probability, right? Next, significant financing. If you remember, significant financing, delivery on day 1 or delivery at the end of the year. In both the scenarios, you have to take जिस दिन डिलीवरी होगा उस दिन कितना रेट था, whenever the delivery was made at that point what was the amount, right? So if you deliver on day 1, the payment is later, you need to check the interest income. And if you get the payment advance but you will deliver after 1 year, so this will be interest expense, that is nothing but cash discount, right? That is cash discount. So revenue is nothing but delivery date amount, that will be the revenue, that is the transaction price, right? Okay, there were two cases. Contract rate is equal to market rate, this was the first case. Contract rate is equal to market rate. Transaction price is equal to delivery date amount. That means if the contract rate and the market rate are same, so I'll say transaction price itself is the same amount. But what if the contract rate and market rate are not same? So what will be the transaction price? It will be present value at the market rate of the future cash flows, right? So you have to take the market rate and not the contract rate. This was the answer, right? There are a few exceptions, 4 exceptions. First is discretion of the customer. It is the gift voucher. I give you the gift voucher. It will depend upon you whether to take the gift voucher, consider the gift voucher right now or after 1 month or 2 months, right? Second is revenue based on royalty. I'll not be able to calculate the amount right now. Third is other than financing. I don't have trust on you. Give me the advance right now, right? So it was other than significant financing. And delivery date is within 1 year. So every IND AS says if the delivery is within 1 year or if at all 1 year, there will be no discounting, right? Third is non-cash transactions. Non-cash. I give you an example. I'm giving you goods. You are filing the returns for me. At that point of time, whatever the things or goods or service I'm getting, that is the fair value of asset or goods received at that point, that fair value will be recorded as revenue. Next, consideration payable to customers. If I am paying you, I'll pay you in 4 scenarios. What are the 4 scenarios? I'll pay you in the form of cashback. So I'll book the revenue on net basis. Second, slot fees. I'll again book on net basis. Third, advertisement. Don't say net. It is careful analysis. It is careful analysis. And fourth is customer provides goods. Customer provides goods. If the customer is providing goods to me, that is gold biscuit. At that point of time, if I am the owner, I'll book on gross basis. Full income of 12 lakh, purchase of 10 lakh. If I'm not getting that control, I have to give you from that gold biscuit itself, I book on net basis. So I've given you over here. These were the 4 points. And the last point was price protection. Price protection. If I'm giving you any price protection, then I'll book on net basis, that I'll reduce the revenue, right? So these are the 5 points. Now, please tell me if you have any query till here. If you have any query till here. We have covered the 3 steps, transaction price. See, uh, when you read it once again, the notes, obviously, I've made it in such a way that with reading only, you'll be able to recall all the points, right? Okay. So moving ahead. So basically, we are done with 3 steps. The first CPTAR, right? CPTAR. C is the contract. Important point was modification. Important point was modification, right? Performance obligation. It can be a single performance obligation or a multiple performance obligation. And the third point is transaction price. It is not necessary that the agreed contract price will be the transaction price. There can be obviously a lot of points, and there are basically 5 points covered in transaction price. That is variable consideration, 2 methods again, expected and the most likely. Second is cash payable to the customers, right? I'm paying something to the customers. Exchange transaction. So basically, there are a lot of points over here which I have already discussed. Significant financing also, and the price production also. Over here, there is the variable consideration is a star mark point over here, and yeah, only I feel this one and the cashback one, that is the consideration payable to the customer. These two are the star mark points over there, right? Okay, moving ahead. Now comes step 4. It is very interesting. Step 4 is very interesting. Allocating the transaction price to performance obligation. Now, what is the step 4 point? Allocating the transaction price to performance obligation. Allocate the transaction price to each performance obligation on standalone price. This is the first point. I have already given you the example of the Airtel, right? There is a standalone prices, but there are 2 exceptions to it of the discounts and variable consideration. Now, what are the 2 exceptions? I'll explain you with the examples itself, okay? But the problem is, if you do not have the standalone selling price at that point of time, what will you do? if you don't have that price, that is the standalone price. So basically you have adjusted market approach, expected cost plus margin approach, and the residual approach. What are the three methods? That means, let's say I'm giving you three products. For two products, I'm having the standalone price, but for third product, I'm not getting the standalone selling price. I always sell this with a combo. So at that point of time, how will I check? So basically, there are three methods: adjusted market price, expected cost plus margin, and the third is residual. Obviously, don't look over here. Just make it understand with the examples, right? So I've given the examples. Please pay attention. Allocation of transaction price to PO, that is performance obligation. Example 1. Let's say I've given you a combo of 36,000 in which there are four subjects. I'm giving you a combo of at 36,000 for FR, for FM, for DT, and for IDT. So basically, I've given you four subjects, right? The standalone selling prices are 15,000, 12,000, 10,000, 8,000. That means if you take one by one, if you take only CFR or FR, it will be 15,000. If you take only FM, that is SFM, it will be 12,000. If you take only DT, it is 10,000. If you take only IDT, it is 8,000. That means a total of 45,000. A total of 45,000. But the combo is 36,000. That means I have given you discount, right? So discount of how much? Discount of 9,000. Discount of 9,000, right? So basically what I have to do is I just have to divide this 36,000 in the ratio of SSP. That is 15 is to 12 is to 10 is to 8. 15 is to 12 is to 10 is to 8. That means for FR, how much have I charged? For FR, how much have I charged? Have I charged 15? Obviously not. Why? Because it was a combo offer, right? So for FR, I'll be charging only 12,000. For FM, I'll be charging 9,600. For DT, I'll be charging 8,000. And for IDT, 6,400. So this is the point. This is the point, right? So basically, discount and allocation will be on the basis of standalone selling price. Now the problem is I don't have the standalone selling price of the fourth product. What will I do? So for that I have three methods over here. Example 2. Just pay attention. The combo is 20,000. The combo is 20,000, right? And FR and FM, that is CFR and SFM, right? So basically there are two FR and FM. 15,000 and 15,000 are the prices, that is 30,000. But I am giving you the combo for 20,000. If you take both the recorded sessions, I'll give you at 20,000. But if you take one by one, I'll be giving you at 15 and 15, the standalone selling prices. So obviously, this 10,000 is the discount. 10,000 is the discount. And this 10,000 will be proportion in the SSP ratio, which is 1:1, 15 is to 15. So the discount is 5,000 and the net amount that will be allocated to FR and FM will be 10 each, right? This is the very basic point. Now the important point is in combo 2. In combo 2, I made one more combo. I made one more combo in which I am providing you with FR, FM, DT, IDT. So initially there were only two subjects and now I am giving you another combo of four subjects. This time it is not 20,000 but this is 35,000. This time I am charging 15,000 extra. Now I was just checking what was the discount. What was the discount? If I'm not giving you the above example of the FR and FM, you will say this 35,000 should be booked in this ratio, in 15 is to 15 is to 8 is to 7, right? But this is not the scenario. If I am giving you two combos, at that point of time, you have to check the discount of both the combos. Why? Is the answer, is the question, right? So the big combo discount I am giving you is 10,000 and the small combo discount is also 10,000. That means if you can closely watch, what was the amount I was charging initially? It was 30,000. And now how much I am charging? 45,000. Extra how much? 15,000. For how many subjects? Two subjects. 15,000. Can I say, if you take it standalone only, I will be giving 15,000 itself, 8 and 7. That means I actually did not give you any discount for these two products. You told me, sir, give me DT and IDT also. I charged the full amount, 8,000, 7,000, 15,000. That means, can I say, I haven't given you any discount over here? The answer is yes. The answer is yes. I haven't given you any discount for the two new subjects. Basically, this is known as the small bundle and this is known as the big bundle. That is big combo. So, if both the discounts are same, the discount will only be applied to the small combo and not to the big combo. Small bundle only, not the big bundle. Because for two subjects, I was giving you 10,000 discount. For four subjects also, I am giving you 10,000 discount. That means, for DT and IDT, where did I give you discount? So, why will DT and IDT bear any discount? It will not bear, right? The discount will be borne only by FR and FM. Because for DT and IDT, I did not give you any discount, right? So, this is the important point. So, this was example 2. Next, so the rule is when discount on small bundle of goods is same as discount on the larger bundle, and the whole discount will be allocated to the smaller bundle goods only, and not to the large bundle, right? Okay. And now the third point is residual approach, which is important question again. Residual approach. What is residual approach? Residual approach means you don't have the standalone selling price. You don't have the standalone selling price. So let's say the combo is 36,000, right? And the amount is 15, 12, 10. 15, 12, 10. And I also give you the discount. I'll give you 3,000 discount on FR, 2,000 on FM, 1,000 on DT. I gave you the clear discount. This is also given, this is also given, right? So I can take the allocation net of, out of this 15, 3,000 was the discount, 12,000 is the allocation, and so on. Out of this 12, 2,000 is discount and 10,000 is the allocation. But this total comes to 31,000. I'm charging 36,000. So whatever the left out is 5,000, it is nothing but SSP. If SSP is not given, 5,000 I'll be allocating to IDT, because 31,000 was the price, but I'm charging 36,000. So whatever the balancing figure is, this is known as residual approach. Now, what are the drawbacks of this approach? The first point is can only be used if the price of one performance obligation is not available. For example, if I was not having selling price of DT also, I cannot use this approach, because obviously the balancing figure will be both. How will I bifurcate into DT and IDT then? So this is the first drawback. Second drawback, if the balance figure comes to 0, let's say the total came to 36,000 only, and this is also 36,000. Can I say it is 0 then? How will I allocate them? So if the balancing figure is 0, then also this method cannot be used. So basically this method cannot be used in two scenarios. First, if there are two balancing figures, if the two SSPs are not given, and if the balancing figure comes directly to 0, at that point of time I will not be able to allocate, right? Next, one more example on residual approach. So basically I have given you 3 examples on residual approach. Please pay attention. Again the same question, 36,000 combo, right? 15,000, 12,000, 10,000, 3,000, 2,000, 1,000. It was given to you. Okay. I have given the net prices. So the balance amount comes to 5,000. But they have also given the range. For example, if I ask you what is the price of IDT, I will say I'm not sure, because it depends upon customer to customer. Some customers have the paying capacity, I give them at 10,000. Some do not have, I only take 7,000, and so on, right? Depending upon customer to customer. At that point of time, if I do not have the exact selling price, if I do not have the exact standalone selling price, I'll take the balancing figure. True, I'll take the balancing figure. But if it is out of range of this approach cannot be used. This approach cannot be used, because I know I haven't sold IDT below 7,000 till date. If this is the case, 7,000, 10,000 will be the entire scenario, and this 5,000, it does not fit in with this range, and therefore this approach cannot be followed. Okay, what if this is in range? Let's say it comes to 8,000. Is this in range? The answer is yes. So I can say I can follow the residual approach also, right? So again, to better make this concept understand, and therefore I've taken one more example, that is question number 55 from our book. An entity regularly sells product XYZ individually, thereby establishing the following standalone selling prices. What are the selling prices? 50,000, 25,000, 45,000. If you take the total, it comes to 45, 20, 60, 70, 120. Total of 120, right? In addition, the entity regularly sells Y and Z together for 50,000. That means they have also given, if you regularly sell Y and Z, this is a small combo. So basically, this is a big combo, and this is a small combo of 2 products. I always give you at 50,000 itself. 50,000. Okay. Now, the entity enters into a contract with a customer to sell product XYZ in exchange for 1 lakh rupees. Now, you only tell me. I was charging 50,000 for Y and Z, and for XYZ, I am charging 1 lakh rupees. That means how much extra I am charging for X? 50,000. Is 50,000 the standalone price? Yes. So, can I say I am not giving any discount only on X? I already gave you a discount on Y. That is, the discount on smaller bundle is also equal to the discount on larger bundle. If you can closely watch, what were the prices of Y and Z? 25 plus 45, 70,000. That 70 I was giving you at 50,000. That means a discount of 20. And now if you add X, I'll charge 50,000 to the smaller bundle. 50 plus 50 is 1 lakh, and I'm charging 1 lakh from you. That means, can I say I'm not giving any discount on X? The answer is yes. So in this scenario, we can closely watch. There were 2 products Y and Z. The standalone selling price was 25, 45 given to you, and I'm charging 45. I'm charging 50,000. This 50,000 will be booked in which ratio? In the ratio of SSP, 25 to 45. So I booked an amount of 17,857 and 31,153. This will be the balancing figures of discount. That means on product Y, I'm giving you 7143 discount, and product Z 12857 discount, right? These are the discount offers which I'm giving you. Now, on the larger bundle, you will not say this 1 lakh will be apportioned in this ratio. Just one. Yeah, you will not say this 1 lakh will be apportioned on this bundle in this selling price ratio. Why? Because the small bundle discount and the large bundle discount was the same, and therefore this discount will be borne only by Y and Z and not by XYZ. So X will not bear any discount if you can closely watch, right? And the reason will be the discount on smaller bundle YZ is substantially the same as the discount of larger bundle. Full discount will be allocated to the smaller bundle, that is Y and Z only. That is, by adding a product also, I did not give you any discount over there, right? Next. So this was the discount case. Next. Case B. I'm reading the question. Case B is residual approach. Residual approach. So basically, what I've given, the entity enters into a contract with the customer to sell products XYZ as described in case A. That contract also includes a promise to transfer product alpha. So there are now 4 products, alpha also. But the total consideration of the contract is 130. I'm charging 30,000 extra. Initially I was charging 1 lakh, and now I'm charging 130. The standalone selling price of alpha is highly variable because the entity sells the product alpha to different customers for a broad range of amounts, that is 15,000 to 45,000. Can I say the range is given? The answer is yes. Now how will you check? I have copy pasted from above this table entirely as it is. This table entirely as it is over here. So I can clearly say 30,000 was the product for alpha. Can I say it suits the range? Because the range was 15 to 45 and 30,000 somewhere in between 15 to 45. And therefore, I can say residual approach can be followed and it is appropriate, right? But in the third scenario, they have changed the amount. Instead of 130, it was 1,05,000 only. It was 1,05,000. Again, copy pasting the same column, same table. If you check, you are getting only 5,000 as the amount. Only 5,000. Is it fitting in the range of 15 to 45? The answer is no, and therefore the residual approach cannot be followed. This should be the answer. Residual approach cannot be followed. It is not appropriate, right? Next. If there is variable consideration, as I told you, there are 2 exceptions of SSP. 2 exceptions for SSP. First is the discount. I already explained you the larger bundle and the smaller bundle discount, and the variable consideration. For example, let's say I gave you a combo of 36,000. I gave you a combo of 36,000, and as soon as you started watching CFR, you realize that I'm teaching CFR exceptionally well, and you were like, sir, because the concepts are now very much clear, right? We want to pay something extra to you. कुछ extra दोगे आप मुझे, right? Let's say 4,000. So this 4,000 is the variable consideration. It was not fixed in the agreement, right? 36,000 was only the amount. But can I say this 4,000 is only for CFR, that is only for FR, not for any other subject. So this 4,000 will only be allocated to FR. But let's say you told that, sir, we want to pay 4,000, but for the entire subjects, for the entire HGPA. We are satisfied with all the subjects. I want to pay 4,000 to all. So I can say 4,000 will be allocated to all the products and not only for FR, right? So variable consideration, that is not fixed in the contract. You will pay or not depending upon how much you are satisfied or not. At that point of time, if you are describing the subject, I'll allocate to that one. If not, then I'll allocate to all. This is nothing but the variable consideration. If any extra amount promised for FR, then allocate only to FR. This is the example which I already gave you, right? So summing up, this is again the chart for that allocation on SSP basis, right? This is step 4. On SSP basis, exception is discount and variable consideration. I've already explained, right? If SSP is not available, then 3 approaches. What are the first approach? First is the market approach. What is market approach? Take from the market rate. Whatever the rates are given, let's say I'm giving this pen to you, but I'm not having this approach. So whatever the similar products available in the market, take that approach, right? Next is cost plus margin. For example, I do not have the selling price of this. But you have the cost, how much cost is incurred, and whatever the percentage you are earning from the other products. Let's say you are earning 20%. Just add a 20%, you get the selling price. And the third approach is residual approach. The third approach is residual approach. Residual approach, if within the range it is accepted, if not in the range, cannot be accepted. Then if residual approach is not accepted, obviously you have to follow any one method of the 2 methods, market approach or cost plus margin, right? Okay. Discount. I already told you, always check discount on smaller and larger bundle, right? If the discount is same for smaller and larger, the discount will only be applied to the smaller and not to larger. Next, variable consideration. If applicable to specific good or service, as I told you, only for FR, right? If you are giving me extra amount for the FR, I'll allocate only to FR. But if you are giving for all the goods, then I'll allocate on the entire combo rate, right? So this is the answer. on SSP basis. I hope the point is clear. This was the fourth step. So we are done with 4 steps. CPTA. C is contract, P is performance obligation, T is transaction price, and A is allocation. The charts are very useful. I have put in a lot of efforts to make this charts. So utilize to the fullest charts, right? Okay, moving ahead. The next point and the last point, step 5, recognize the revenue. How to recognize the revenue? I've already explained you in the first example itself. That is, if as soon as your performance obligation gets completed, router was completed on day 1, installation was completed on day 1, you can book, that is, you can recognize the revenue on the spot. But can you recognize the revenue of the internet service? The answer is no, because the performance obligation was not satisfied, right? So as soon as the performance obligation gets satisfied, you can start booking the revenue over the period or at one point of time, right? Now, when will I say at one point of time, or when will I say after, over the period? So over here I have given the point. It completely depends upon the transfer of control. What is transfer of control? When the rights are transferred to the buyer, right? Whoever is buying, let's say you are the buyer, I have given you this pen. So as soon as I give you all the rights to substantially use this product, at that point of time I can say that transfer, the control is transferred, right? So when will it be say at the point of time, and when will it be said as over the period? So over here, if any of the condition is met, it will be considered as over. Any of the condition, not all, right? If none of the condition is met, then it should be booked at the point itself. And what are the 3 conditions over here? I'll explain you with an example. Live FR teaching. For example, you are sitting with me live. You are sitting with me live, and the batch is of 3 months. In the first month itself, I complete 50%. So whatever the fees I have charged, I'll book revenue 50% in the first month itself. That is, customers simultaneously receives and consumes the benefits provided by the entity's performance as the entity performance. I'm performing over here. I'm coming over here on daily basis. I'm giving lectures, right? And you are utilizing simultaneously. You are getting the benefits. You are getting the benefits right now. Simultaneously and consume the benefits every day, right? So in that point of time, it is over the period. Will I book the entire fees in the first month itself? The answer is no. I'll book over the period of the 3 months, right? Next. Second is, entity's performance creates or enhances the asset that the customer controls, and as asset is created or enhanced. Now, what do you mean by this? Let's say you have a building and I'm just painting on it. I'm just painting on it, right? So can I say the asset is yours? I'm just painting. Painting is the service I'm providing you. I'm just enhancing your product. I'm just enhancing your product. At that point of time, I'll book over the period. That is, if the painting is job is for 60 days or 120 days or so on. So I'll book over the period each and every day, right? Example, painting service on the customer's asset. And the third point is very important. Third point, asset being created does not have any alternative use, and on cancellation, entity has the right of payment of the performance complete till date. Now, what do you mean by this? See, there should be 2 conditions, both of them should be satisfied. The contract should be cancelled by the customer, not by us. And in the contract, it is clearly written that whatever the expense till date is there. I'm not telling about the penalty. Okay, pay me 10,000 penalty. No. Whatever the expense till date has been occurred plus a 20% margin. For example, you gave me a contract to make a software, and I told you I'll be handing over the software after 2 years. So I was continuously, making expenses on R&D and making a software for you. Till date, and the contract price was, let's say, 1 crore. After 2 years, you'll pay me 1 crore as soon as I hand over the software to you, right? So expense till date. Now, after 1 year, let's say you're canceling the contract. But in that scenario, you are the customer, you are canceling the contract. In that scenario, I will say whatever my expense has been incurred till date. For example, let's say 30 lakh rupees I have incurred, 30 lakh rupees. Plus, we have already made an agreement. If any of the party cancels, they will have to pay 20%. That means you will pay me 36 lakh rupees right now. In this scenario, I'll book this 36 lakh over the period of the contract, right? So this is the scenario. So basically, there are 3 points. That is, customer simultaneously receives and consumes the benefit. Second, asset is of the entity, we are just enhancing it. And the third point, cancellation is made by the customer, and I'm not taking a penalty. I'm taking the entire cost, whatever is incurred till date, plus my margin also, right? At this point of time, I'll book over the period. And if none of the criteria is satisfied, I'll book at one point of time, right? So these are the scenarios. These are the scenarios over here. Now, Method of control. Now, this output and input. So basically, there are two methods of measuring the progress. First is the output, and the second is input. Input is always used in construction. If you remember AS7, it was construction contracts, right? So basically, AS7 and AS9 has now become IND AS 115. So basically, two are mixed over here. So output based is nothing but how much goods I'm giving it to you or how much service I'm providing it to you on that basis. But if it is construction, obviously I cannot say I've sold one flat, I've sold two flats. What I'll be doing is I've completed. If I'm a contractor, I have to use the percentage completion method. Percentage completion method. For example, how much material was actually expected. Let's say the material was expected to be 1 crore. And in first year, I've completed only 30% material. That is purchased only 30% material. So in that scenario, I'll take 30% as the input, right? So I'll take in the percentage completion. And on output basis, how much revenue has been booked? That is 40%, 50%, and so on. Right? Next. Abnormal losses and wastages should be excluded while booking the income. Any unused material should not be used. That is, closing stock should be subtracted. And if input and costs are evenly again, then we can use straight line method, right? Okay, moving ahead. Special cases. Now, basically there are 12 special cases, and these are the last 12 special cases of this IND AS. So over here, we are done with all the 5 points. Just 1 minute, yeah. So we are done with all the 5 points, right? So basically, CPTAR now done. C is contract, P is performance, T is transaction price, A is allocation, and R is revenue recognition, right? Over here, I will say these two, or else these three. There is TAR, transaction price, allocation. These are very, very, very important, right? Okay. Moving ahead. Now, special cases. What are the special cases? First is principal versus agent. Now, what we have to do is we just have to recognize who is the principal and who is agent. Who is the principal and who is the agent. If I am the principal, I'll book revenue on gross basis. And if I am the agent, I'll book revenue as commission, that is on net basis, not on the gross basis. For example, I told you to make a sale and pay you a commission of 5%. You are my agent. I told you whatever the sale amount is, I'll give you 5%, right? So obviously I'm the principal, you are the agent. So principal, let's say you made a sale of 1 lakh rupees. Of this 1 lakh, 5,000 will be the commission. So you'll pay me 95,000, right? You'll pay me 95,000. So should I book revenue of 95,000 or should I book revenue of 1 lakh? I haven't made the sales. You are the agent, you have made the sales. So should I book the revenue of 95 or 1 lakh? So the answer is on gross basis. That means I'll book sale of 1 lakh gross and commission of 5,000 as my expense because I'm paying you. I'll not book it on net basis, I'll book it on gross basis. And think from your point of view, from the agent point of view. What is the income for agent? Can I say that 5,000? This 1 lakh rupees is not the sale for him, right? He's only 5,000. So in his PNL, he'll only charge commission of 5,000. That is on net basis. So the rules for principal and agent are: principal goes for gross basis and agent goes for net basis. Now the question comes, who is the principal and who is the agent? You have to recognize that. So for that, I have given you a question. I'm reading out. Please pay attention. An entity negotiates with major airlines to purchase tickets at reduced rates compared with the prices of tickets sold directly by the airlines to the public. So basically, what is happening? This are the air tickets sold by the airlines. They directly sell to the customers, right? They directly sell to the customers. But what I've told, if I am the entity over here, we are the entity, and we went to the airlines and I told them I'll purchase so and so tickets. Let's say give me 100 tickets. Give me 100 tickets at a discounted rate, and this will depend upon me. I'll sell to the customers. So are we acting like an agent? Obviously you will say yes, I'm acting as an agent, but it is not the scenario. You have to analyze the facts again. Now what were the conditions? You have to analyze that. If the risk is upon you, you will say you are the principal. You are not the agent. If the risk is on airline, then you are the agent. So how will you recognize? So basically, I told them I'll sell 100 tickets. That is, I'll purchase 100 from you and I'll sell 100. But the point is, I told them I am purchasing 100 and you don't have to worry irrespective of. Even if I'm not able to sell one of the ticket, any single of the ticket, I'll pay you for 100 ticket for sure. That means, can I say the entire risk and reward passed on to the entity? Because anyhow, in any case, he will be paying for 100 tickets. Even if he is not able to sell to the customers, he will be paying for 100 tickets. So can I say the entire risk has been transferred to the entity? The answer is yes. In this scenario, the entity is the principal and not the agent. This is the question itself. So I've explained you in short just to save some time. The entity also assists. Okay, what are the cases? I'm just reading the second sentence. The entity agrees to buy a specific number of tickets, let's say 100 tickets, and will pay for those tickets even if it is not able to resell. So the point was over here only. If it is not able to resell only, then also he will be paying for 100 tickets. That means the entire risk has been transferred. So entity is acting as an principal and not as an agent, right? So the entity is a principal, not an agent, or an agent, not an agent, right? Not an agent. Okay, moving on. Non-refundable upfront fees. So basically there are 12 points as I told you. What was the first point? It was principal versus agent. Okay. Second point is non-refundable upfront fees. Now what is exactly non-refundable upfront fees? I'll explain you. This is nothing but registration fees. This is nothing but registration fees. For example, if you go to a gym, and they told that you have to pay 12,000 as per annum fees, 12,000, and you also have to pay 3,000 as registration one time registration, one time. So I'm talking about this 1,000. This is non-refundable, right? One time non-refundable fees. I won't refund it. So basically, if I own a gym, you are coming to me and you are paying me 12,000. I'm also telling you, fill up the form. You have to register yourself for the first time by paying rupees 3,000. This is known as upfront non-refundable fees, right? You have to pay 3,000. Now, how to book this 3,000? Should I book it one time or should I book it on per annum basis? This depends upon whether I'm providing you something with this. For example, I gave you a gym kit. As soon as you gave me this 3,000 as registration, I gave you a gym kit. That means I'm charging this 3,000 for the gym kit. Can I say it like this? I'm charging this 3,000 for the gym kit, right? So in this scenario, this 3,000 can be booked immediately, this 3,000, and this 12,000 over the period of 1 year. But if I'm not providing you any gym kit, at that point of time, I can say this 15,000 is entirely for 1 year and will be booked over the period of time. That is 15,000 will be booked in 12 months, not 12,000 and 3,000. So if I'm providing something with this, that means I can say this gym kit is for 3,000 and this 12,000 is for per annum. But if I'm not providing anything at that point of time, 15,000 will be treated as the per annum and will be booked over the period. So this is the example I've already given to you. Just one. Yeah. Over here, I've written the entire example which I gave you right now. So this is non-refundable upfront fees. Okay. Third point, customer options for additional goods or services. Customer options for additional goods or services means what? I've given you an example. I'll explain the example itself. See, customer purchases 5 movie tickets on Sunday at rupees 300 per ticket. That means he paid rupees 1,500. So if you are a customer, I am the owner of the multiplex or the theater, right? So you took 5 tickets for me. At that point of time, what I gave you is nothing but a voucher. I gave you two tickets free, which you can redeem on weekday, on any weekday. That is Monday to Thursday. You can come and you can get 2 tickets for free, right? And obviously, this will not be as free, right? Because I have to distribute on SSP ratio. So what will I be doing? I'll take this 100 rupees ticket on weekday. Let's say on weekend I obviously charge 300, but on weekday the show is not full and I only charge rupees 100. So at that point of time, day 1 you will pay 1,500 for 2 POs. That is 2 separate POs. First is on Sunday and the second is on weekday, right? So what were the standalone selling prices? 1,500 was for the 5 tickets and 200, that is 100 per ticket for 2 tickets, 700. So I'll apportion this on SSP ratio. 1,324 are 5 tickets, right? And 2 tickets, the amount is 176, which will be on weekday, right? So as soon as you give me the amount of 1,500, I cannot say this is my income for first day. I'll make it like this: bank account debit 1,500, to sales, that is revenue, I can book only of 1324 because 176 is advance I have taken for weekday, right? So to advance income, that is liability. So if at all on weekday you come, I'll trade as revenue. Weekday either redeemed or lapsed. Advance revenue to advance income to revenue. I'll book it like this, right? So basically, if I'm giving you for free, nothing is free in this world. Nothing is free, right? So in that point of time, you have to consider the standalone selling prices and you have to apportion it on SSP ratio, right? If it is free. So I've given an example, and over here, note, while calculating SSP for free voucher, take probability into consideration. You also have to check the probability. So this was the question I was talking about. This was asked in the recent examination. Question number 23 from our book. It was copy pasted as it is. It was already there in our book. It was copy pasted. Okay. So question number 23. What is the point? An entity enters into a contract for the sale of a product A for ₹1,000. As part of the contract, the entity gives a customer 40% discount voucher for any future purchases for up to ₹1,000 in the next 30 days. That means you went to a store and you sold product A for 1,000, right? Along with that, you gave him a discount coupon of 40%, which he can avail if he purchases up to ₹1,000 and within next 30 days. That means you went to, let's say, Shoppers Stop, you purchased something for 1,000 and Shoppers Stop gave you a discount coupon of 40% for the next purchase in 30 days. If you purchase up to 1,000, they will give you 40% discount, right? So in that scenario, obviously for Shoppers Stop, they are giving you 40% discount. Nothing is free, right? So the entity intends to offer a 10% discount on all sales during the next 30 days as part of seasonal promotion. So basically, he gave you a coupon of 40%, but during the next 30 days, it was a season sale, and therefore 10% he was giving to everyone only. So can I say he is giving you only 30% extra? He is giving you only 30% extra. The 10% discount cannot be used in addition to 40% discount voucher. That means we cannot say that 40% discount and 10% your sale. They will give you only 40%. That means 30% extra they are giving you, right? The entity believes that there is 80% likelihood that the customer will redeem the voucher. That means 80% chances are that you will go to Shoppers Stop and again shop for 1,000 rupees or less than that. And the customer will purchase for ₹500 of additional products. That means what is the discount you will be getting? So for product A, the selling price was 1,000. But for the discount voucher, what was the selling price for the discount voucher? You will say 500 rupees was the amount into 30% discount you are offering, and you will take only 80%, that is the probability, right? So the standalone price comes to 120. This is how we calculate the standalone price of the discount voucher, which was important. This was the exam question asked for 7 marks, which was very easy. Standalone price 1,000 of product A. Along with product A, Shoppers Stop won't say that they are only selling 1,000. They are also giving you a discount coupon. So they are also selling you the discount coupon also. So what is the value of their discount coupon? The value of their discount coupon is 120. How come they calculate 120? They estimated how much will be the purchase. So the customer will come and they'll purchase only for 500, right? Next, 30% is the discount I'm giving you, not 40%, because 10% I'm giving to everyone. So 30% is the answer, and the chances are 80% he will come and purchase, right? 20% are there that will not come only for the discount. So total transaction price is 1,000. Again, the same scenario. Divide in this SSP ratio. There is product and discount voucher. To be recognized on day 1 and to be recognized over the period of 30 days. That is after 30 days, or when the amount when it uses it, or when the amount when the time period expires, right? So basically, this is how you will calculate the amount on SSP ratio. Next, sale with a right to return. Now, what is sale with a right to return? It is nothing but sale on approval basis. Sale on approval basis. Just 1 minute. Yeah, sale on approval basis. Just give me 1 minute. Okay, moving ahead. So basically, what is sale on approval basis? I sold a product and I also gave you a return period. The Amazon and Flipkart do it like this only, right? So basically, you can return a particular product during that particular time period, right? So in that scenario, Will the Flipkart book revenue after the sale period expires? The answer is no. It will take the expectation. For example, see, I'll just take it with this example only. Flipkart sold 10 iPhones for rupees 1.5 lakhs each. So it was nothing but 16 Pro Max, 1.5 lakhs. Okay, and 10 iPhones were there. Cost of an iPhone is 1.2 lakhs, and he's earning 30,000 on one iPhone. 10 days return policy, and Flipkart expects 3 iPhones to be returned, and they're expecting 3 iPhones will be returned, but 7 will be sold for sure, right? So they'll make 3 iPhones as nothing but advance income. Three iPhones but as nothing but advance income, because the customer paid for 10 iPhones, but obviously when they will return 3 iPhones, you'll have to pay back. So in that scenario, sale with the right to return is nothing but on day 1 you are getting income of 15 lakh rupees, 10 iPhones into 1.5. To revenue, you will book income of only 7 iPhones. Why? Because you are expecting 3 iPhones to be returned. And to refund liability, there is advance income. You can use the word refund liability or advance income for 3 iPhones. The amount was 4,50,000. Right? The important is this: on day 1, you will also pass one more entry. Because the goods, the 3 iPhones are with customers. You also have the right to receive those 3 iPhones, right? Because if you are treating this as advance income, you also have an asset, right? How come asset? Because obviously, if the customer returns, you also have the right to receive those assets. Only if you receive that iPhone, you will be paying back, right? So you also get a right to receive asset, to COGS, that is P&L. If you are getting it back, obviously you will credit to P&L. You will not book as expense, right? So you will credit to P&L in the name of COGS, but not the selling price, the cost price. That is 1.2 lakhs into 3 iPhones. That is the only cost price. So basically, it is nothing but as good as sale on approval. It is as good as sale on approval. Why sale on approval? You booked a sale. You booked the sale for 7 iPhones, but for 3 iPhones, you will book it as an advance income. Also, advance income means liability. You are creating a liability in your books, but you also have the right to receive the asset. So you will book the asset as 3,60,000 on the day 1 itself, right? Okay. So after 10 days, what will happen? Either the customer will return the goods, or else he will keep the goods, because it was nothing but an estimate, right? So if the iPhones are returned, you will say refund liability to bank, and whatever the entry was here, you will reverse that. That is COGS to right to receive. That means you received the asset. That is, there is no more asset to you, and you have paid back. Or else the customer will not return. No returns. At that point of time, can I say you can charge it to revenue again? That is, now you can say there is no liability now. That is completely revenue, and again reverse this entry, because you don't have any right to receive the asset now. So basically, whatever you have created on day 1 will be reversed after the return period expires, or when the returns are made. Returns, if you return it, you'll charge it to bank, that is, you are paying back. If you are not returning it, if they are not returning, you will obviously charge it to revenue. This is the important point. So this is sale with a right to return. Next, over here, right to return, I have taken an example. Right to return: an entity enters into a contract with 1,000 customers. Each contract includes the sale of one product of rupees 50. That is 1,000 total products into 50. 50,000 is the total consideration. 50,000. Okay. Cash is received when control of a product transfers. The entity's customary business practice is to allow a customer to return any unused product within 30 days and receive a full refund. The entity's cost of each product is 30 rupees. That means they can return the goods within 30 days. Now, 50 rupees is the sale price and the cost is 30. We got these 2 points. The entity applies the requirements in IND AS 115 to the portfolio of 1,000 contracts, because it is reasonably expects that, in accordance with paragraph 4, the effects of the financial statements from applying these requirements to the portfolio would not differ materially from applying the requirements to the individual contracts with the portfolio. It is of no use. Okay. Since the contract allows a customer to return the products, the consideration received from the customer is variable. To estimate the variable consideration to which the entity will be entitled, the entity decides to use the expected value method. Expected value, if you remember the variable consideration, because it is the method that the entity expects to better predict the amount of consideration of which he is entitled. Using the expected value, the entity estimates that 970 products will not be returned. That means 30 products will be returned. 30 products, right? The entity estimates that the cost of recovering these products will be immaterial and expects that the returns products can be resold at a profit. Determine the amount of revenue, refund liability, and the asset to be recognized. See, it is very simple. How much you are getting? It is bank account debit. You are getting 1000 into 50, right? But can you book the income of 1000? The answer is no. Why? Because 970 you are expecting and 30 you are expecting the return. So you will say to revenue of 970 only and to refund liability, that is advance income of 30. And this is not the same. You will book one more entry. What is the entry? The entry is right to receive asset. If they are not sold, obviously you will get it back. And how much units you will get? 30 units at rupees 30, because I want to take the cost price, right, to COGS, or you can say PN. This is the answer. So I've given you these two entries. I've given you these two entries. There is refund liability of 30 products, 30 units into 50 rupees. And also don't forget this entry. This is important, because right to receive asset should also be created. Right to receive asset should also be created and at cost. So in exams, you don't have to write the journal entry. Explain the entire concept in your own language. That is, whatever I did, you have to explain right in words. What will you do? Obviously, you will book revenue for 970 units only. You have to create a liability, that is refund liability for 30 units, right? And this is the case. So whatever the journal entry is, write the journal entry in words. This is nothing but the explanation, right? Okay. The next is restocking fees. Now, what is restocking fees? This is nothing but charged for returns. Charged for returns. For example, turning the same example of Flipkart which I gave you. He sold 10 iPhones, right? And he also gave a disclaimer that if you are returning the product, he will give 1000 less, because of the transportation of the packing got unpacked, right? The mobile got unpacked, so obviously there will be loss for me. So Flipkart clearly told, if you are returning the product, he will not give you 1000. That means for the 1,50,000 was the selling price of the iPhone. He will be returning only 1,49,000. 1000 he will not return. Can I say this 1000 is the complete income even if the products are returned? The answer is yes. So what Flipkart will be doing is bank 10 iPhones 15 lakh, right? To revenue of the 7 iPhones to 1,50,000. For 3 iPhones, 1000 is for sure I'll be getting, right? Even if the customer returns, 1000 is for sure he'll be getting it. And this is 1053 and 357 will be the return amount. 357 will be return. Instead of 360, sorry, not 190. I'm so sorry. This is 457, not 190. Is 149. Yeah, 447. Instead of 450, I'll be returning 447 only. Why 447? For the simple reason, 1000, I am complete sure that it is my income, because I will not be returning you, right? And again, the same entry, I'll be booking at cost. So only the thing, what happened is 3000 jumped from this entry to this entry. 3000 from year to year. Why 3000? For the simple reason, I'm giving you restocking fees. Restocking fees is nothing but if I'm taking it back, I'll charge something. So that is nothing but revenue for me. Okay. Next, warranty. So basically, what is warranty? So if the customer has to extend the warranty, option to purchase warranty separately. That means there are two performance obligation. First is the product and the second is warranty. So product will be booked on the spot and warranty will be booked over the period, if you have the option. But you do not have any option to extend the warranty. That is, if you're taking the product, let's say you are taking this iPhone from me, I'm giving you a 1 year compulsory warranty. I'm not charging anything extra from you. So what I'll be doing, I'll book the complete. This is only one single performance obligation, that is mobile. I'm not giving you warranty. Yes, but as per IND AS 37 provision, that is provision for expenses will be made. That is a provision entry will be made for warranty. Okay, so this is the point. So I've given the example. Please pay attention. Sold mobile plus 1 year warranty compulsory. So I'll treat this as a single performance obligation. That is, selling a mobile was the answer, not the warranty. Warranty I'm giving you complimentary, right? So book the entire revenue on day one. Also create a provision as per IND AS 37. I'll be creating a provision for expenses, whatever the expenses will be based on past records. I'll be considering that, right? But sold mobile plus 3 years extended warranty. If I'm giving you extended warranty, that is multiple P. Mobile is separate and performance obligation is separate. So mobile will be recognized on the day one, and warranty will be recognized over the period of 3 years, obviously on the basis of ratio of SSP, that is stand-alone selling prices. This is warranty, right? Next. So I've again given an example of warranty. This is again very simple. I'll just give you the brief idea. So basically, there were computers and 3 years warranty was given. And they have clearly given the bifurcated figures of 32 is of computer and 4000 is of warranty, not as SSP. They have clearly given. We have already bifurcated for you. So what is revenue on day one? 32 you will book on for computer, and for warranty you will book over the period, right? And over the period, what is the journal entry? Bank to revenue to contract liability, there is advance income, 4,000 is the advance income, and derecognized inventory, there is okay, there was a second point in this scenario. I'll just make you understand over there. And provision, this one was important. Provision, 2,000 was the repair expenses. If the product returns, 2,000 is the repair expenses which you have to make an entry, right? Now for this 14,400, I have to read the question over here. Just pay attention. The entity determines that the standalone selling price of the computer is 32 and 4. It was clearly given. The inventory value of the computer is 14,490. So even if you are removing the computer, you have to just remove from the COGS to inventory. This is the derecognized entry. Inventory. If you're not making this entry, this is not compulsory, but even if you make it, that is a good thing. Institute will not deduct any marks for you, right? So basically, the rule is if the warranty is sold separately, it will be a portion on SSP, and provision for warranty will be made separately, right? If it is not separable, it will be treated as a single performance, and the entire amount will be booked, and provision as per IND AS 37 will be booked, right? Next. Yes, consignment. I hope you know what is consignment. So basically there are two parties, consignor and consignee. Just as a principal agent, the amount, right? So basically consignor will book on gross basis and consignee will book on net basis. But when to book? When the goods are sold by the consignee to a third party. When he'll sell to the third party, only then the consignor will be able to book the sale on gross basis, and the consignee will take the commission on net basis. Okay, so this is the answer. Next, sale and repurchase. Now what is sale and repurchase? One of the simple points, sale and repurchase. A Limited sold goods of 100 lakh rupees to B Limited, right? But I also told you that I'll repurchase the goods. Then why did you sell? So IND AS 115 recognize this fact that basically you wanted some money, and as a mortgage, as a collateral, you gave these goods to them. So basically, I will not consider this as revenue. It will be treated as finance because you have took a loan. See, you are telling the party that let's say A Limited went to B Limited, A Limited went to B Limited and asked for 100 lakh rupees. So they told that okay, I'll give you 100 lakh rupees, but you have to give some collateral. So what you did is you sold goods to him as a collateral. Take my goods, keep it with you for 1 lakh, right? And after 1 year, I'll purchase the goods back from you, but at a higher price. Why higher price? These are your goods only. You are purchasing at a higher price because you wanted that amount as a loan, and this 10 lakh will be treated as the finance cost. So it will be treated as loan, right? So basically, if you are purchasing it again, it will be treated as a finance agreement, right? So basically, in this scenario, it will be treated as if A Limited took a loan from B Limited and mortgaged goods. So this amount, the journal will be something like this: bank to loan, 100 lakhs. At the year end, interest will be charged, interest to finance, interest to loan, 10 lakhs. And after 1 year, I'll pay back the amount as 110, that is loan to bank, right? So this was the entry. But there's also second scenario, purchase, that is sale and repurchase. So basically, A Limited sold goods of 100 and agreed to repurchase it at 90 lakh rupees. That means this will be considered as the leasing agreement. How come leasing agreement? See, I gave you 400 lakhs because you wanted these goods, right? You wanted these goods, you wanted to use these goods, but you don't want to purchase that. So I told you, okay, take these goods for 100 lakh rupees. After 1 year, I'll take back at 90 lakh rupees. Can I say I'm charging 10 lakh rupees for the lease? 10 lakh rupees for the lease. So this will be considered as the lease agreement, not the revenue income, right? So consider as lease agreement. In this scenario, it will be treated as if A Limited gave B Limited the goods for the period for 1 year, will charge 10 lakhs and as lease rent for the same. That means I'm giving you at 100 and I'm repurchasing at 90. That means I'm charging 10 lakh rupees for that loan. ये क्या है? तो ये सेल एंड रीपर्चेस चालू है. This is sale and repurchase. IND AS 115. So is it something new which you haven't heard of this? Okay. The next scenario. So basically there are two scenarios for it, right? Next point. Bill and hold. Now what is bill and hold? We are almost at the end of this IND AS. So basically there are only 3-4 points left. Bill and hold. So Mr. A is a customer. Mr. A is a customer and He purchases a laptop for 80,000. He purchases a laptop and Reliance Digital is the seller. Reliance Digital, right? Requested to take the delivery after 6 months. So customer is requesting that give me the delivery after 6 months. So what will Reliance do? Obviously, Reliance will book the revenue on day one because it is delayed at the part of the customer. So we have billed and hold, that is delayed at the part of customer. So at that point of time, Reliance will book the revenue itself. But also sometimes, Reliance will charge for warehousing. That is, I'm holding this product for you only. That is storage. So give me the storage cost extra. Storage cost. So basically, if at all I'm charging, in that scenario, it will be treated as two separate POs. Allocation and SSP ratio will be made. For example, the laptop amount was 75,000 and the custodial service, if I'm holding the inventory for 6 months, it will get 15,000 as the custodial service, custodial charge, right? So basically there is the amount is 90,000, but I'm charging only 80,000 from you. So this will be treated as two separate POs and it will be apportioned in laptop and custodial services and so on, right? So this is the scenario. This is the scenario of bill and hold. Next one. License of intellectual property. Intellectual property is nothing but you are giving the license. You are giving the license just like Netflix or Amazon. So for example, Eros Media World, they gave a license right to Amazon Prime of 30 old movies for 10 years. That means Eros sold a license to Amazon and he took some fees for that. They gave 30 movies and they can run for 10 years. Amazon can run for 10 years. Can I say there are old movies and these have already been completed? Yes. So for Eros Limited, whatever Amazon Prime pays for, let's say they paid 10 crore rupees, 10 crore. Eros can book the 10 crore on day one itself. Why on day one? Because of the simple reason, there is no performance to be fulfilled after this. Is there any performance obligation? Is there any obligation left? The answer is no. As soon as it handed over the old movies, you can run it all over. Eros will say my obligations are all completed. Now there is no more obligation to be completed, right? But if in the next scenario, the same case, but of 5 movies which Eros will make and then release on Amazon. So basically, Amazon paid 10 crores to them, but Eros promised that during the period, I will make 5 movies and then you run it on Amazon, right? Then you run it on Amazon Prime. In that scenario, can I say Eros has some performance obligation to be completed because it will have to make movies and then pay it back, right? So basically, if the movies are yet to be made, obviously it cannot book the revenue on day one. It will have to be booked on the over the period of time, right? So this is basically the true point. This is nothing but licensed of intellectual property, and there are 2 points left. But before that, I'll be taking the revision of the cases. So basically, there are 12 special cases, right? First special case, the principal and the agent. So principal will book on gross basis. The agent will book on net basis. Revenue to be booked when goods are sold to third party. This is important, right? Second is non-refundable upfront fees. Just remember the example of the gym, right? If additional goods and services are provided, then 2 POs. That is 2 separate performance obligations. Gym kit day one book income and that 12,000 will be booked over the period, right? But if no additional goods are provided, then the entire amount should be merged. That is, the entire 15,000 was for the 1 year, right? That was non-refundable. Next is customer options, additional goods and services. If they are getting free movie tickets, vouchers, reward points and something, if something is like this, treat the discount voucher as separate PO. And how will I calculate the discount voucher? What is the SSP of the discount voucher? That is nothing but estimated future purchase. Whatever the amount of future purchase is into additional discount, whatever the extra discount, remember that 30% into probability. If the probability rate is given, just multiply the answer by probability, right? This was the third scenario. Next, right to return. Right to return, as I told you, if I'm Flipkart and I'm getting the 3 iPhones return, see, you'll be able to analyze all these points if you remember the examples which I gave you, right? If you are Flipkart and if you are getting the goods back, at that point of time, you have to pass 2 entries. First is the refund liability, that is advance income, and also the right to receive asset. This was important case, right? So refund liability and just 1 minute. Just 1 minute. Yeah, over here. Refund liability also and the right to receive asset also. 2 entries, right? Okay. Next is restocking. The same example of Flipkart. Restocking is nothing but charge for returns. If I'm charging anything for returns, I'll book the revenue on day one itself. Next, warranty. Warranty, If it is no separate warranty, it has to be mixed with the product itself. There is no separate performance obligation. At that point of time, entire mobile income will be treated as the revenue and provision will be made for the provision returns as per IND AS 37. But if I'm making an extended warranty, so this will be treated as two separate products, right? And it will be a portion on SSP. Next is consignment, same as principal agent. Next, sale and repurchase. What was sale and repurchase? I'm selling and I'm repurchasing. Obviously, there were 2 points. If I'm selling at 100 and repurchasing at 110, that means it is loan agreement. I'm paying you 10 lakh as interest. But if I'm giving you at 100, I'm purchasing at 90. That means I gave you to use it, and I'm repurchasing at 90. That means 10 lakh is nothing but the lease agreement. So basically, whenever there is sale and repurchase, at that point of time, it will be treated as either finance income or the lease agreement, right? Next, bill and hold. Bill and hold is nothing but delayed at request of the customer. That means if I'm Reliance Digital and you are taking a laptop, but you want it after 6 months, you have billed it, you have paid it, right? But you want the delivery after 6 months. So will I wait for 6 months for to the revenue to be recognized? The answer is no. I'll book on day 1 itself. But if I'm also charging for custodial services, the income will be apportioned in SSP ratio for the custodial service also. Next, license of intellectual property rights. If I gave you at one point of time the old movies, it will book on one time itself. That is day 1 itself. But if you are booking on the new movies, that is you will make and then you will book over the period, right? This is the point. Now, the next point is contract cost. Now, what is contract cost? Basically, this is as good as AS7. AS7. So, there are only 2 to 3 theory questions on this. So, I'll be discussing those also. Acquisition cost and fulfillment cost. Now, what is acquisition and what is fulfillment? Acquisition cost means it will be incurred whether or not. So, basically, there are 2 points. Incurred or whether or not the contract is received. For example, I want to take up a contract. So I hired 2 employees. I told them, go there, just explain all the terms and conditions, and then if the customer is ready, take the contract. So now, will those people work for me without salary? The answer is no. Do I have to pay them a salary if I get the contract? Yes. Do I have to pay the salary if they do not get the contract? The answer is still yes, because they tried their best, right? So if at all incurred whether or not the contract is received, the expenses will be charged to P&L. Obviously, it will not be capitalized. But incurred because of the contract, I'm incurring the expense because of this contract. Because just as I got the contract, I paid a legal fees. Just because I got the contract, I gave it the performance bonus. At that point of time, I need to capitalize it to the amount. That is, I will charge the amount to the contract cost itself, not to the P&L, right? Okay. Next, fulfillment cost. That means if I got the contract, now obviously I need to fulfill it. How will I fulfill it? Obviously, by expense, by making some expense. So covered in another IND AS. If those expenses are covered in another IND AS, for example, I'm using an asset, so it will be covered under IND AS 16 pp. If I'm using intangible asset, it will be covered under 38. If I'm using inventory, it will be covered under IND AS 2. So if there is any IND AS provided for that, use it. Use whatever the valuation is given in that IND AS, go with that. If it is not covered, then capitalize. If it is not covered, then capitalize. So these are the points on contract cost. So basically, 2 types of cost are there. First is acquisition and second is fulfillment. Acquisition, whether or not the expense will be done, whether or not you get the contract. So the answer is P&L. If you are making the expense only because of this contract, then capitalize. If it is fulfillment and it is covered under another IND AS, so make the provisions of that another IND AS. If it is not covered under any other IND AS, then capitalize it. So these are the points. So basically, if you check these points, commission paid only upon successful signing of the contract. I'll pay you commission if the contract is signed. Obviously, it is because of this contract itself. So if it is because of this contract, I'll capitalize it. Second, travel expense for salesperson pitching a new client. It may happen that they are pitching a new client, but we may get a contract or not get. But we have to spend it, right? We have to spend it, and therefore it is expense. Next, legal fees for drafting terms of arrangement for parties to approve and sign. Legal fees I'm paying, but it may happen that the parties run away, they do not sign it. Obviously, it is nothing but expense, but it is not capitalized, right? Next, salaries for salespeople working exclusively on obtaining the new clients. I will get new clients or not, it is not very sure, but I have to pay them salaries. So again, expense, whether or not, right? Bonus paid on quarterly sales target. If the target will be achieved, only then I'll give you the salary, right? So if it is because of the contract, I'll capitalize. Next, Commission paid to sales manager based on contracts obtained by the sales manager local employees. Again, the target based. If you are getting a target, obviously you will capitalize it. That is, it is completely based on the targets. Just one minute. Yeah. So, please give it a read for these 6 points because these are important. This was again asked in the examination, that is whether to capitalize or whether to expense it out, right? So there are 3 points which you should capitalize. I've given the summary over here also. I've given the summary, acquisition cost and fulfillment cost, right? So I've given the summary, just give it a read. Okay, and to the last point. After this last point also, I have taken a few more questions, 2-3 questions more. Okay, so just pay attention. What is service concession arrangements? Service concession arrangements is nothing but the contracts which I am receiving from the government for infrastructure, for making bridges, for making the highways and so on. So basically there will be 2 points over there. I'm not reading it out, I'm just explaining you with the example. Just pay attention. Service concessional agreement. Construction 40 crores and it will get considered in 3 years, right? But that was not the contract. Just 1 minute. Yeah, over here. So basically, there was a construction. So the arrangement was something like this. I'll tell you again. If I'm the contractor and I got a contract from the government to build a highway, okay, to build a highway. So I estimated a cost. The cost was 40 crores for the construction, right? And then they also told that after building, you have to also maintain it for 10 years. 10 years you have to maintain also. Okay, so obviously operate करने के लिए खर्चा लगेगा. For I have to employ some labors to it for tolls and all. So operation I have to pay them 20 crores for the entire 10 years, right? So 60 crores is my expense, and obviously I took a loan and interest cost was 5 crores. So total 65 crores I have to spend for in the entire 13-year life. 3 years was the only the construction. For 10 years I have to operate it, and then I also have to take a loan of that, right? So basically I have spent it 65 crores on this, 65 crores on this contract. Obviously I'll not do this for free, right? I'll take something from the government. So the contract price which the government fixed was 91 crores, which it was fixed for 91 crores. So available book obviously on the basis of the expense on the SSP ratio. The SSP ratio was 40, 20 and 5. But this will not be treated as SSP, this will be treated as cost. Why cost? Because it is nothing but construction, and construction takes the completion stage, right? So 40, 20 and 5, the income will also be booked in the 40, 25 ratio. So for construction is 56, for operation is 28, and for what is happening this one? Yeah. So basically I booked the 91 crore income on the basis of 40, 25, on the basis of their expense, right? So how will this income be booked? 56, 28 and 7. 56 will be booked over the period of 3 years because the construction life was 3 years. 28 will be booked on 10 years and 7 years will be booked on the basis of 13 years. So I've written over there. I've written everything over here. This was not the important. The important case is second one. Government told that I will not pay you a single penny. You spend 65 crores, true, but I will not pay you a single penny out of this. I don't know what's happening. Just 1 minute. Yeah, the government says, I will not pay you. What you do is, you build up a toll on both the sides, on both the ends, right? And collect tolls for the next 10 years. And collect tolls, that means I'm getting a toll right. It is treated as an intangible asset. It is treated as an intangible asset. So what I'll be doing is, first of all, whatever the construction cost is 65, I'll be paying it. So 65 crore is the construction cost to bank, right? I paid entire 65, assuming that I have completely paid. Okay. Second, I'll get the right of intangible asset. So I'll book intangible asset to revenue 91. Intangible asset to revenue 91. So you will say, sir, you have booked entirely 91. The answer is no. I haven't booked 91. But what I'll be doing is, I'll be charging amortization to intangible asset. That is, I'll be charging the expense on amortization basis. That is, on day 1, I booked 65 expense, and on day 1, I booked 91 income. Complete. That is, obviously the difference is profit, right? Amortization will be 91. Again, that means, can I say 91 will be again reduced off to P&L? Yes. So basically it will be over the period. and whatever the toll comes in, I'll collect it and I'll charge to revenue again. So these are the 4 entries which I'll be making. First of all, first entry is 65. Whatever the expenditure is made, you will make it like that, right? Second point, intangible asset. You will book an intangible asset, that is intangible asset to revenue, and obviously you will amortize over the period of 10 years, right? You will amortize over the period of 10 years. And whatever the revenue comes in, you will book bank to revenue, and whatever the toll amount is collected, you will book on that year itself. So these are nothing but the service concession arrangement. So basically, I'm providing you services for operation also, and this is known as BOT, that is build, operate, and transfer. You built it, operate it, and then after 13 years, that is after the period of 10 years of operation, you transfer the entire rights to the government. This is what you do with the service arrangements. So basically, there were 12 special points, 10 of which I've already taken the revision. These 2 were the last points, the contract cost, and the last was service arrangement. The service arrangement, right? So basically, we are done with entire IND AS 115, in which I have taken CPTAR. These are the 5 steps, of which these 3 steps were very important. TAR, that is the transaction price, allocation, and the recognition. Apart from that, there are 12 special cases. If you read these 12 special cases once again, I'm very much sure you will be able to answer each and every question in the examination. Each and every question. None of the question, it won't be any scenario in which you will not be able to answer. If you read it carefully, I've made the notes in such a way that you'll be, understanding each and every point in detail. Okay. And I've taken a few more questions. Just be patient and just check the questions. Question number 22. Entity sells gym membership for 7,500 for per year to 100 customers, with an option to renew it at a discount in second and third years at 6,000 per year. That means on the first year, you have to pay 7,500, and I'm giving an option 7,500 pay right now. And if you extend your membership for second and third year also, then you have to pay 6,000 only for the second year and third year only at 6,000, not the 7,500 again. Okay. So how will I book the revenue in the first year? They are asking that. How will you book the revenue in the first year? See, and what they have given is entity estimates an annual attrition rate of 50%. Attrition rate is nothing but they will leave. They will leave. 50% will leave and 50% will be retained. That means out of the 100 customers, in the second year, there will be only 50 customers. And the third year, there will be only 25 customers. That is 50 or 50%, right? So I have given over here. Just pay attention. In year 1, I was having 100 customers and they were paying 7,500 each. That means I was getting 7,50,000. Okay. In year 2, 50% will be left out, right? So only 50% will renew the contract, that is renew the membership. They'll pay only 6,000. They'll pay only 6,000. And in the third year, again 50% of this will be renewed and they'll pay 6,000. So what is the total amount I'll be getting? What is the total amount I'll be getting? Yeah, the total amount I'll be getting is 12 lakh. For how many, from how many customers? 175 customers. So the average rate comes to 6857. That is 12 lakh divided by 175. 6857. So of the 7,500 you are giving me, of the 7,500, so the entry of 7,500 should be something like this: bank to sales, that is bank to revenue, right? 7,500. But can I book the entire revenue of 7,500? The answer is no. You can book only 6857, and the rest amount will be treated as the advance income. That is, you have already taken the advance income for the next year, right? So this is the answer: advance income. Okay, moving ahead. Next question. Next question. It is a retrospective effect. I've already taken this, but I felt this was an important question. That's why I'm taking over here. ST Limited enters into a contract with a customer on 1st April 21 to sell product X for rupees 1,000 per unit. Okay, I have to sell 1,000 per unit. Okay. If the customer purchases more than 100 units in the financial year, the contract specifies that the price per unit is retrospectively reduced to 900. That means if you will purchase more than 100, I will give it 900 itself. For example, if you're taking 5, yeah, if you're taking 5, then at that point of time, I'll be charging 1,000, right? But then again you take 15, I'll charge 8,000. But if you cross, what is happening? Just 1 minute. Yeah, to sell at 1,000. But if you cross 100 limits, 100 units, then I'll charge at 900 starting from the first unit itself. That means I'll give you 100 rupees discount on each and every product which you have already taken. That is retrospective effect. Okay. Consequently, the consideration in the contract is variable. For the first quarter, that is ended 30 June, the entity sells 10 units of product A to the customer, only 10 units. And the entity estimates that the customer's purchase will not exceed the 100 unit threshold. That means what I'm expecting is you took only 10 units in the first quarter. You will not purchase 100 units. So obviously, I'll be charging at 1000. Why do I give you discount? I'll be charging at 1000. So how much is the revenue which I charge? 10 units into 1000. How much is the revenue I booked? It is 10 units into 1000. This one. Yeah. Okay, 10 units into 1000. Next. The volume discount in the financial year. HT Limited determines that it has significant experience with this product and with the purchasing pattern of the customer. Thus, HT Limited concludes that it is highly probable that a significant reversal in the cumulative approach of the revenue recognized, that is 1000, will not occur when the uncertainty is resolved, when the total amount of purchases is unknown. That means they are telling that we will not be able to cross this 100 unit threshold. Further, in May 21, the customer acquires another company, and in the second quarter, ended 30 September, the entity sells an additional 50 units of product A to the customer. That means this time in the second quarter, you sold 50 units. Initially, you booked 10 and now you are selling 50. That means total of 60 units. And in the light of the new fact, the entity re-estimates that the customer purchase will exceed the threshold. That is, now you are sure that the 100 unit limit will be crossed. Now, can I say, if it will be 100, the first quarter which you booked was 10,000. That is 10,000 units into 1,000. That means you booked an income of 10,000. Can I say in the second quarter you need to reverse? Because you should have booked the income on 900 basis. You should book the income on 900, not on 1,000, right? So can I say it is time for reversal? How much extra did you book? 100 rupees. 100 into 10 units, 1,000. This 1,000 you should reverse the income in the second quarter. This 1,000 you should book reverse the income. Just one. Yeah, over here. Over here. So, revenue recognized is 10 units into 1,000, that is 10,000. And in the second quarter, what you have to do is 50 units into 900, because now you are very much short, that is 45,000. But what you have to do is previously booked, since it was retrospective. So previously also you should have booked at 900. Why did you book at 1000 then? So you have to make it 900. Can I say the extra income of 100 rupees should be reversed? So the reversal of 10 units into 100 will be reversed, and therefore, sorry, this is only 1,000, not 10,000, only 1,000. So this will be 44,000 as income, right? I hope the point is clear. Next, the last question. The last question. It is basically incentives. If you remember, the expected value, variable consideration, expected and the most likely, right? So this is that question itself. So please pay attention. The last question, 32. An entity has fixed fee contract of rupees 1 lakh. Sorry, 1 million. 1 million is 10 lakh rupees. To develop a product that meets specified performance criteria. Estimated cost to complete the contract is 9,50,000. That means the completion will be 950, that is my cost, and I will be getting 10 lakh rupees. 50,000 is my income. The entity will transfer control of the product over 5 years. And the entity uses cost to cost input method to measure progress. That means whatever the cost is incurred, that is this 10 lakh rupees will be booked on the cost basis in the ratio of the cost to measure progress on contract. An incentive award is available if the product meets the criteria. That means there are also incentives, variable consideration. If the weight is 951 or greater, you will not get any incentive. If the weight is between 701 to 950, you will get award of 10%. That means 1 lakh rupees. And if the weight is less than 700, you will get a reward of 25%. As 25% of this 1 lakh will give you 2 lakh 50, right? 2 lakh 50. That means this you are getting an incentive. The entity has extensive experience creating products that will meet the specific performance. Based on its experience, the entity has identified 5 engineering alternatives that will achieve 10% incentive, and that the 2 will achieve 25% incentive. In this case, the entity determined that it has 95% chances that it will achieve 10%. That means this is 95% chances. And 20% chances that it will check the 25% chances. So they have given the percentages, confidence, that means probability, right? Probability of getting or not. After that, based on the analysis, the entity believes 10% to be most likely amount when estimating the transaction price. Now they are telling most likely. That means most likely. If you remember, most likely, no use of probabilities, right? Okay. Therefore, the entity includes only 10% award in the transaction price when calculating revenue because the entity concluded it is probable than the significant reversal in the amount. Now, what they are telling is, instead of this method, I have taken the most likely approach. And since most likely approach, there is no income, there is no probability included. What I've done is I've taken this 1 lakh to be the suitable income. So basically, 1 million, that is 10 lakh, plus this 1 lakh as the variable consideration. That means I've taken the 11 lakh as my revenue, right? Okay, 11 lakh as my revenue. Next, after that, the entity reassesses its production on quarterly basis to determine whether it is on the track or to meet the incentive reward. At the end of the year 4, that is in the 4th year, it becomes apparent that this contract will fully achieve the weight-based criterion, that is this one. That means in the 4th year, it will be 250. That means it is retrospective, right? Okay. Because there is no new service and there is more incentive. Therefore, the entity revises an estimate of variable consideration to 25%. Initially, you booked at 11 lakh and now you're booking at 2,50,000 in the year 4. It is probable that the significant reversal in the amount will be cumulative achieved. And the expenses of 9,50,000 are given like this. Can I say, initially for this 11 lakhs, 10 lakhs was the 1 million and 1 lakh rupees initially for 3 years I was making that I will get only 1 lakh. So I'll book 11 lakh in this ratio. So how should I book? Obviously 50, 175, 40 in the ratio of this one. So I've given the answer over here. So basically I should book the fixed consideration of 10 lakhs in this ratio. 50, 175, 400, 275 and 50. Of that 1 lakh, can I say for first 3 years I was expecting 1 lakh? Yes. So 1 lakh, just give me 1 minute. इतना हुआ है सिर्फ एक लास्ट क्वेश्चन के लिए प्रॉब्लम दे रहा है. Just 1 minute now. Yeah. So for that 1 lakh, I can say 50 is to 175 is to 400 was the true answer. But only for 3 years. Only for first 3 years. For the 4th year, I will not be doing like this. Why? Because now I have estimated as 2,50,000. Now I estimated at 2,50,000. So what you have to do is for the first 1 lakh rupees, obviously you'll apportion this ratio 50 is to 175 is to 400 is to 275 is to 50. So if you take 1 lakh in this ratio, for the first 3 years, you'll be getting 5 to 60, 18, 421, 40 to 105. But the remaining amount, 2,50,000, you will apportion in the ratio of 275 is to 50. That is this one, 275 is to 150. That means total income you should book at rupees 2,50,000. But the problem over here is the cumulative catch up. This is the important point. Why cumulative catch up? Because you should have booked 2,50,000 from day one itself, but you have booked only 1 lakh. So can I say it is extra amount? Yes. So if it was 2,50,000, first 4 years, what was the total expense? If you can check, the total expense was 9 lakh rupees. 9 lakh rupees of the 9,50,000. That means, can I say for the 4 years, you should have booked 2,50,000 in 9 lakh is to 950 ratio. That means you should have booked 236. But for the 4 years, you have booked only this much amount. Over here, you can see 5 to 63, 18, 421, 40 to 105 and 7 to 368. For the first 4 years, you have only booked this much. That means, can I say additional amount you should book? So 98,685 is the additional amount which you should book in year 4 because the estimate got changed in year 4. So this is known as the cumulative catch-up. And in year 4, you should book additional income because in the initial 3 years, you were thinking that you will earn only 1 lakh rupees. But in year 4, it came to a notice that you will not achieve only 1 lakh, but you will take 2,50,000. That means the estimate got revised. And if the estimates are revised, you will take the cumulative catch-up, that is the retrospective effect, right? The retrospective effect. So this was the last point, and I feel this was one of the very tough question or one of the very important question from exam point of view. I can say it has not been asked in the examination, but can surely be asked in the examination. We have already covered this. So whatever I felt was important, I've covered in this entire IND AS, and I feel that सब लोगों को समझ में आया होगा मैंने क्या क्या दिया है. So I've also given the charts over there, so you can, after revising the complete part, you can just refer a chart and then again revision and revision and revision, right? So this is the point. In IND AS 115, it is not expected that you will copy paste the answers from the study material itself. You can give your answers in your own language, provided that you are on the point, that is you are giving them the concept what is there in IND AS, right? So that's it for today, and this will be all from my side. Okay, so I'm just ending the stream, and if you have any query, feel free to ask, and then I'll end the stream. If you have any query, please let me know. uh, 110 जो है ना, actually I wanted to take 110 also, but for the next 4 days my commitments are for CMA Inter now. CMA Inter. For the next 4 days, I've stayed marathons for Group 2 accounts and costing, and again for Group 1 accounts and costing for the next 4 days, right? So what I'll do is I'll just try to record and then upload 110. No, I'm not committing it right now, but I'll obviously try my best to record it in these 4 days itself and upload it directly. I'll not be taking it live, but I'll be uploading it. If I get time, I'll surely upload it. Okay, sure then. I'll end the stream now.